in listen-only mode.
Well, all right. Hello, everybody. Happy Saturday morning.
Hello, traders. Yeah, welcome to the webinar. Looking forward to this, getting out here and sharing some ideas with you.
So what we got, is just a basic PowerPoint here with 50 or so slides talking about swing scalping, which is kind of a methodology that we've incorporated over the last year and a half, 2 years here to kind of add to the repertoire of our trading. We do both day trading and swing trading. For those of you who don't know, both Andy and I have been trading our own accounts since 1998, and we have a service where we allow people to come in and watch live, much like you're doing right now on GoToMeeting, live trading and get some concepts in real time. We also do weekly webinars, but on those weekly webinars we just kind of scratch the surface of what happened over the past week, talk about a few trades and look at charts and take questions from people. It's been 2 years since we've done a format webinar like this for instruction, and we just thought it was time to kind of come back and share some updated strategies that we've been doing. We will look at some recent trades that we've taken in the examples that we're going to do today, which I think is important, rather than going back and picking a chart and using hindsight. You could have done this and you could have done that. These are trades that we've done on our accounts over the last probably week or two. So it's very fresh content, and it's much easier for us to talk about it in that respect. We'll try and hit on maybe 4 or 5 really strong key concepts that you all can take away from this webinar today, and we'll definitely hit on those as they come through. And just a quick note, I think everybody that is here today, we've got a nice group, looks like they're in. If you miss any part of it and you want to rehash it, it will be available to you as a recording. So what you can do is just email me maybe after today, and I can get you the setups and how to get you set up to watch that. So what we'll do is we'll just move forward here and kind of go start from scratch. This is a little bit of background on us. Again, we have been mentoring people since 2007. It was actually Andy that first picked up a contract to head over to China and trade with a prop group over there, about 500 traders in Shenyang, China. And you can see this was the small group that Andy worked with. I also went down there and traveled to China a couple of times and helped this group as well. And what's unique, as you can see in the background there, the desktop sharing. This was really the birth of how we came about with the desktop sharing and the education. When we were not in China, it was a great way to keep in touch with the students there. And that was, again, a few years ago, and this is just more footage of how many traders they had. I think they had 500 traders in that building. And it was a fun experience, but that was kind of the beginning of the mentoring side of what Andy and I have been doing over the last few years, in addition to continuing to trade our own account. Last year we were approached by the New York Times. They got wind of what we were doing and thought it was an interesting concept, and you can see the Sunday New York Business Times. We got a nice piece last March, and it's still in there. I think it's March 28th, New York Times, just talking about what we've been doing and the concept of it, and it was a nice warm surprise for us to be able to participate. Now you can see Andy working at home there with his daughter in the background jumping on the bed. And that's pretty much how it is. We don't go to an office. We work at home. We trade our own accounts, and we really enjoy taking the time and patience to try and help other people, learn some ways to make some money and learn some ways to avoid some mistakes. Continuing on here on the bio portion of this, there's a new concept that approached us over the summer. It's called Ditto Trade. Some of our current subscribers are probably familiar with it, and many people coming to this video on a recording, may be coming to this video to kind of learn the style that we will be incorporating in Ditto Trade. And again, Ditto Trade is basically a way for people to open up an account and attach their trades literally to the trades of a master trader, or maybe somebody in their family that they trust as a good trader. And again, we were approached to do this. Andy is the master trader, as you can see, and the point of bringing this up is what we're going to talk about today is the swing trading, swing scalping method, and this is primarily the method that we're going to deploy in Ditto Trade for people who are curious. So this here is basically the bio page on Ditto Trade, talking about Andy and myself a little bit, and some of the styles and approaches.
I'd like to add something on that ditto
Yeah.
trade too, because there's been other concepts out there, but what makes a ditto trade unique is you do, when he says attach to a trade, I mean you literally attach to a trade. You get the exact same price as the master trader gets on both the entries and the exits. So it's a mirroring service, but there's actually none like it, because the other ones out there, you cannot actually get the same exact feel that the trader guy gets. But anyway, just want to throw that
Slippage, yeah, they call that slippage, over time and over. Yeah, it's the only way to actually participate in the exact same block trade. So you're getting in at the same price and getting out at the same price. It's a cool concept, and it's coming out of beta, and we've got some followers right now that have been with us, and it's growing, and it's been a lot of fun. And I'll just mention, going forward here, you probably have some questions. It's probably best in this format to just write the question down and hang on to it, and when we get to our question and answer session, we'll go back and look at some live charts and kind of hit on those in that segment. So that's probably best. You just let us go through the slides here, and then definitely come back with some questions at the end, and we can rehash some things looking at current charts. So I titled this slide "Change is the Only Constant," and that's really something that we've subscribed to. When you're playing the markets, nothing will last forever. If inefficiencies will come and go, the ability to exploit certain market tactics will come and they'll go, and they will evolve and they will change. And the market is ever changing. And so, putting it this perspective, the market's always going to be changing, and you've got to be aware of that. And in that vein, probably the biggest change we've experienced since 1998 over the years has been the introduction of high-frequency trading, and HFT as it's called, or algorithm. And if you're not familiar with it, I'm going to spend a little time here setting it up because I think it's very important to see where this new swing scalping method evolved from and why it evolved. And primarily it's because the noise that has been happening here in the markets. HFT algorithm dominates in the markets in all time frames. And we're noticing that more and more. There is a lot of noise on the intraday charts and even on the daily charts these days. And this noise is primarily due to the fact that no longer are the majority of market participants people, human beings, sitting at their desk executing decisions with their fingertips. It's pretty much 70% of the volume and the liquidity in this market that we have now is done by computers and algorithms in very fast time frames. Microseconds. And what it's done is it's changed the dynamics of our markets, and we'll hit a little bit about how that's happened. What we've had recently is what's called like a liquidity-driven market. Basically, don't fight the Fed, as I'm calling it. We all know QE1 and QE2. The Fed has been injecting tons of liquidity into the market, and it's finding its way back into the markets in the form of just a rising bid, a rising tide of equities we've seen, and we'll look at some charts on that for sure. But most evident, what we're seeing are more moves in the overnight markets and less moves in the intraday markets. So what that leaves us with is, like I said, more overnight moves, but more narrow range doji days. What I mean by doji, if you're not familiar, this plus sign right here I added is what a doji would look like on a chart. Doji basically means a stalemate, a war with no winner. The buyers and sellers battle it out, and the stock or the market closes pretty much exactly where it opened, maybe with a little bit of range to the upside, a little bit of range to the downside. And I'm going to show you a chart here to kind of illustrate that. This is the S&P going back through the summer, late August, when this rally that we've seen over the last numerous months here really began to occur. And what I'll do is I'll just kind of go in here and highlight, because I've never seen so many of this before. But there's a lot of narrow range dojis in here. We got one here, we've got one here, here. We can even call some of these little spinning tops dojis. Here's a perfect one there, here, here. So here's another one here, here. The market's moving higher, but it's doing so less on the intraday time frame and more, here's some gaps, a lot of gaps. We didn't used to see this many narrow range days, doji, doji, doji. There's 3 in a row. Those are the kind of days. There's almost 4 out of 5 days right there. These are the kind of days that can drive a day trader nuts going back and forth, because you're just not getting a lot of movement intraday. But the chart is still moving from left to right. in an orderly fashion. Anything you want to add to this slide?
No, totally agree with you there. And this is much similar to the action you saw from the bottoms we hit in March 2009, right?
Yes. Yeah.
Yeah. March 2009 through basically through 9 and 10. So it's very similar. This has been going on now for a couple of years, and it's a new dynamic, and a lot of it has to do with the things Steve just mentioned there, and primarily high frequency trading, because they don't go take overnight positions, and they go home flat. So you get a lot of this this type of action throughout the day and throughout the year, obviously.
Mm-hmm. So again, I mentioned I wanted to hit again on the market structure. High frequency trading, is about 70% of the market structure right now. And, we know it's creating a lot of noise, a lot of days where there's no winners, no losers. And the reason is algorithms don't go home overnight taking positions. Algorithms are there to primarily service the coming and going of market participants. They're really only in it for a penny or 2 or 3 cents at the most to get in, get out, and take advantage of their fast, low latency computer systems. And I'll explain a little bit more of that. But you can see here in this Forbes article, the 6 giant banks made $51 billion last year, basically just turning on their machines and handling stock transactions with their proprietary algorithms. So there's a lot of money in it. It's a big industry, and it's been great for the big banks and the ones with their trading desks. And I also want to say there's a lot of other smaller shadow groups out there that deploy algorithms. They're not well-known banks, but they're like I said, shadow groups that are in there just quietly sitting back and taking this market structure for the good side, because it's working for them for now at least. Some more data here. Trading revenues at the banks, like Goldman Sachs, they accounted for almost 36% of trading. Algorithm trading last year. Bank of America, JP Morgan, Morgan Stanley, Citigroup. These are the big 5. And you can see collectively these guys raked in billions of dollars, $23 billion a year alone just for Goldman Sachs. But it's been great for them. Like I said, it's been a great deal for them, but it's been very difficult for the average trader who has fallen back on a lot of the things that they've incorporated over the years to try and adjust for the noise and some of the trading action that's come in. So that's why I said it's without a doubt HFT has been the biggest adjustment to change that we've had in years. And I know I'm talking a lot here to start off, guys, on day trading and algorithm trading, but we really feel it sets the foundation and sets the stage for going into the swing scalping. So for those that are not aware still of what HFT is, remember I said it is 70% of daily liquidity is what the average, is what the estimates are these days. 70% of average daily liquidity is being handled by computers and algorithms. And they're basically the new market makers, but they're not really subject to the old market making handling rules or transparency. And that is, if you recall, May 6th is what people call the flash crash. Andy and I and a lot of people believe that the way this market structure is it led to a flash crash. And unfortunately, that really shook the confidence and trust of the retail public. And they have bailed since then. They're slowly coming back, but it's been a big deal. And I did recently read that Mary Shapiro at the SEC is getting ready to maybe address this and starting to apply some rules and regulations to these high-frequency trading groups, because in a sense they really are our market makers. And the market makers of the days in the past had much more regulation and transparency and oversight. So hopefully there's going to be some more of that coming in the future. Real quickly, here's their game. Here's what these HFTs like to do. Like I said, all those dojis on the daily chart, these algorithms, they do not go home long stock. They do not take risk home. Their game, their playing field is between the bell. And their only interest is to facilitate an order and try and get something for them out of it. In other words, what's in it for them? Well, the way their networks are set up and their sophisticated algorithms are set up, they can monitor things that we can't even see, and they can monitor them in flash, milliseconds, 500 milliseconds or less. And they're playing for pennies and rebates mostly. real quickly, a rebate is an ECN like ARCA, NASDAQ, BATS, EDGX. If you sit there and advertise a price, and you're sitting on the bid and somebody sells to you and transacts with you because of your advertised price, well, you are there creating liquidity, and you get what's called a rebate. And when you start to add up those rebates, we're talking $2 per 1,000 shares. That's where a lot of these high-frequency outfits make a lot of their money, catching rebates by providing liquidity and getting money back from the ECNs and exchanges. So that's the first way they make money. The second way they make money is they're really only playing for a penny or two in most cases. And they do that by looking throughout. Boy, I tell you, there's like numerous exchanges now. There's, I think, over 40 different dark pools, and I'll explain that in a second. There's many different fragmented pieces to this market we have. It's no longer one floor with everybody standing there and everybody sees everybody's bids and offers. There's super fragmented issues where we just cannot see. And in those moments of, we call them arbitrage, where you might be able to buy this particular stock on this exchange and flip it and sell it over there on this exchange over here, or maybe this dark pool exchange over there, and make a penny because there is a momentary arbitrage opportunity. And that's really where their interest is taking your order, quickly looking to see if there's a place they can dump it and make a penny or two and get out, and they're done. Just call it like a hot potato. It's just a bunch of hot potatoes being tossed around by these algorithms, and they're calling it market liquidity. Well, the last point I want to hit on the slide here is, let's say this is the NASDAQ building. This is an actual building. Let's say this is the New York Stock Exchange, an actual building. Well, located very close to those exchanges are what's called the high-frequency trading server farms, or co-location facilities, meaning they're co-located right next to the facilities. And having this amount of short of cable, I mean, this could just be a mile of cable for all we know, gives them a tremendous advantage of speed. And that speed is what allows them to quickly look and see if there is something available to them to dump your order and make a penny on it. And if there's not, they're just going to back away. I know it's kind of a hard concept to grasp, but the fact that they're located so close to the exchanges and they have such fast systems, as these blue lines here are orders coming and going, they can literally have an advanced look on these orders and see if they want to trade against them, or they can back away. And they literally have about 500 milliseconds to do so. And I don't want to get too esoteric in here, but the bottom line is they kind of have a half a second, 500 milliseconds to decide whether or not they want to trade with you. And in the old days, that wasn't the case. You put up a price, you're going to be good for it. You're going to get hit for it. But these days, if there's nothing in it for them at that moment, they have really the ability to back away to a higher price and try and force you to pay a higher price. And that's just not really fair. Anything you want to add to this slide, Andy, before I move on?
Yeah, I want to stress the importance of why we're hitting on this so much, and you need to realize who your enemy is out there. And even though this is all about intraday trading, they can have a big impact, a big influence, especially in the first hour, on how some of these stocks can react and the influence they can have on some of these charts. And I know this because we have been stopped out before. Our method of swing scalping, a lot of times we'll use some tight stops, and this over the last couple of years we've noticed the price action in the first hour, it can be really exaggerated from where it was 3 or 4 years ago. And so you have to keep this in the back of your mind, when you're putting in stops, when you're looking for entries. There's a lot of things you need to focus on when you're making a trade, because I'm serious. That's why they introduced this, what's it called, halting the stocks after a 10% move. Yeah, circuit breakers, because a lot of it is just due to the
instability,
high-frequency trading. Yeah, instability in the market. So you need to be aware of what's going on out there. That's about it, Steve.
Sure. Yeah, and a good point Andy brings up is in the art of war, you definitely want to know your enemy, know the other side, and how they operate and what their motivations are. And that would be the case there. Here's one more quick little slide I put together. This is a level 2 box, something we always watch and you should be familiar with. This is what we see. We see the ECNs, such as ARCA, such as NASDAQ. Those are ECNs. We see the specialist here, NYSE. That's the New York specialist. We see other exchanges. There's Cincinnati Exchange. There's Amex on there. There's other exchanges.
EDGX.
These are things we can see. But there are things we cannot see, and I linked to this time and sales here with these little dark circles to indicate what we call dark pools. And they're basically not visible, to the average investor. They're only visible to institutions and people who pay for access, and that's all part of this algorithm chain. And so for an example, some of the people on our live service will see on Andy's desktop and hear him get frustrated. Let's say, for example, you're trying to buy Morgan Stanley here at 2201, and you send a limit order. I want to pay 2201, nothing more. Because trust me, if you send a market order, you're probably not going to get 2201. If you send a limit order to 2201, and these guys at that moment, ARCA, NASDAQ, BATS, and these participants that are playing on here, they see the order coming. If there's not something in it for them at that moment, in other words, if they can't look here to this dark pool and dump it off and make a penny or two to an arbitrage situation, they will literally back away, because I told you, if there's nothing in it for them, they can back away. Now, there may be somebody there who has no intention of doing that and is good for it, and you can transact with them. But just because you see 4 participants here on the offer when you're trying to execute a trade and trigger an entry does not mean that you're necessarily going to get it. That's the game they play. They have the ability. It's almost like a hologram. They have the ability to back away if it doesn't suit their needs, and they're not in it for charity to help give you a fill. They're in it to try and find a way to make a penny or a rebate or whatever they can on your order, and they're doing this throughout the market thousands, if not millions of times a day. This is going on. So whatever you do when you're trading in a micro level, don't send market orders, because you probably would not get 2201. You'd probably get 2202. They'll see it come at them as a market order and code it as a market order, and they'll say, well, that was pretty simple. All I have to do is back away a penny and sell it to you, and then buy it back cheaper on one of these dark pool exchanges that the average person cannot see.
Mm-hmm.
Okay, so that's kind of the backdrop of HFT and the pitfalls and the difficulty of it. How do you combat it? And that's what we were scratching our head with. How do you combat this noise? How do you avoid thinking you have a good entry and getting wiggled out and banged out only because of intraday noise? Well, the first thing you can do is adjust your time frame. Day trading versus swing trading, the same stock and the same setup. Andy actually has a good story about that. Many times you'll have the same stock in 2 different time frames, and why don't you elaborate on that?
Sure. Yeah, the concept kind of came to my attention about 2 years ago, when I noticed there was something strange going on in the marketplace, and I've never seen anything like this before. I knew there was something freakish going on out there. High frequency trading was just scratching the surface. You didn't hear anything about it, and actually seeing my day trading profits decline. And so what I did is I said, well, I need to pick up more of my swing trading account. Over the years, my day trading account, it just killed my swing trading account. But I noticed, okay, I'm going on a couple of months here, my swing trading account's doing much better. So what I started doing is seeing a lot of these setups on the day trading account, and we'll go over some of those setups here in a minute, very similar to what I did in the past. And I would see a beautiful setup that I normally see on in my day trading, and I would, take a sizable position, and at the same time I would buy the stock, because a lot of times it's on a nice looking daily chart. So I'd buy the stock in my swing trading account, sizably less amount, but and then sure enough, I would sit there and get jerked around and end up either flatting or losing in my day trading account, and just the smaller position I took in my swing trading account, I wouldn't be shaken out by the noise of 10 cents or 15 cents, whatever it was. And I noticed here it was 2 or 3 days later, and had some nice profits in my swing trade, and I wasn't making anything in this day trading. I'm going, wow, I'm seeing this way too much. But so anyway, it kind of evolved by doing that, seeing these same trades that I could not make money in my day trading account where I used to all the time, and but yet still making some nice profits in my swing trading account. And I started to say, well, I wasn't going for big moves. I was basically taking a daily setup on a possible momentum burst, and started taking about 2 or 3 days out of it and getting some nice profits out of it. So that's kind of how it evolved.
So Basically, like Andy said, being able to, you used to be able to bang out some nice day trading moves. Well, what's happened is when you're playing in the 1 to 5 minute time frame on the day trading level, and I'm talking a few years ago, it was much easier to see moves, position yourself for the move, participate in the move, and then get out of the move for a pretty simple, clean move. That's difficult now. There's so much
Absolutely.
noise, and we will show you some examples here. There's so much noise in the market that I say it's almost like if you're still trying to make money in the 1 to 5 minute time frame, quickly scalping for nickels and dimes and 5 cents here and 8 cents here, chances are it's going to be almost impossible, literally, if you're going to do that as your only focus. My point is you can't beat the chess computer at chess, and in this game right now, the chess computer is HFT, and they own the 1 to 5 minute time frame. You just have to realize that they own that.
Mm-hmm.
So one of the things we did, and this is a key concept here, and I've got a few key concepts, like I said, to take away from this session. The first one is we recently went from a 5-minute intraday chart to a 10-minute intraday chart. Now again, we're not talking about day trading, but as you'll see, we still need to have a good grasp of the intraday chart to help time our entries and our exits on our swing trades. We don't just look at daily charts. We're still focusing on the intraday setups for signals and timing. And let me just show you an example here of what a 5-minute chart, and well, actually we will hit that in a second. We talk a lot about noise. What is the noise that we've been talking about that has been so difficult to get our hands around? Here would be a typical setup. It's a 5-minute chart on Bank of America, and this is about last June. This is an older slide put together last June. And here what you see, I'll quickly set this up. Here is the beginning of the day, and you'll see some wide ranges, typical for the opening. And Bank of America is holding up very well. The bid is holding up. It's moving up to highs, showing some relative strength on the open. And the reason I know it's relative strength is here is a quick slide of what the spiders were doing on the same time frame. Nice market, open with the spiders, but then the spiders wake up and just violently lurch back down and try and shake everybody out here. This, as it were, became the low of the day. I don't have the rest of the day for the spiders chart, but I will tell you we went back last night and just verified this was the low of the day. The spiders, by the end of the day, had moved higher, and the S&P finished at or near its highs on a nice green candle. The problem was Bank of America, when you see on the next slide, here is where we left off. Bank of America went down and tried to shake everybody out to lows. Now, mind you, this is about the time where the S&Ps are starting to recover. And one of the oldest setups in our old book in day trading was identify relative strength. Well, we saw Bank of America was holding up very well as the market was going to lows. Well, as soon as the market recovered, the old playbook had suggested get long and stay long that stock that was relatively strong because people are wanting to buy it. And if the market starts to move higher, this thing is going to get away from you. Well, that just doesn't work anymore. This is a typical example of what happened to Bank of America the rest of the day. We're talking just noise, noise, and noise. And then lo and behold, look, the last half hour of the day, it completes its move. It did exactly what it intended to do. If we call that point A and point B, stocks are still moving from point A to point B on the daily charts. They're just doing it in a difficult way. I think a more reasonable approach for what Bank of America could have done, this particular day would maybe, move up and then consolidate midday and then maybe finish a little stronger. But this incredible noise is very typical of what's been happening lately, and it's really designed to shake the trader out. Anything you want to add there, real quick?
No, very good point. Yeah, it's just it's anarchy, a lot of times in these charts, especially. And Bank of America is one of the most high freaked stocks out there, along with Citigroup, Ford, some of your big boys. And like I said, we don't want to
Spend too much time
on this concept, but we just wanted to kind of show you what we were up against, and so.
Okay.
Yeah, I think it's probably enough on that.
So I mentioned earlier one of the key concepts to take away, and the people in our room, they all agree, they've watched us, we agree that moving from the 5-minute chart to the 10-minute chart on our intraday charts has been the best move in the last 3 months, without a doubt. It has definitely helped, and I'm going to give you a quick illustration here as to why that is the case. So what we're going to do is we're going to look at the same stock, Microsoft, and we're going to look at the same time frame here. What I'm going to do is I'm going to kind of bookend the day for you here. this is the day we're going to focus on. So here on a 5-minute chart, we've got Microsoft opening up. Typical, we'll talk about how this noise in the first part of the action of the day is very normal and how we try to avoid it. But if you were trading the stock and looking for a move, you can see this 2780 level was breached, nice move there, and then HFT gets a hold of it and slams it right back down. And the important thing to note here is breaking this 10 period and this 20 period moving average. Just broke it, just a lot of noise right there. Probably enough to scare some people out that weren't having conviction that it wanted to move higher. Again, later on in the day, pulls higher, moves back. More noise. You know, these moving averages in our older webinars used to have a lot more semblance and organization to them. They used to hold a lot better. But the high frequency trading is creating so much noise that they're breaking down a lot of these things. So what we did is we moved to a 10-minute chart. And again, I'm going to highlight, here's the same day in Microsoft. You can see more data because there's less bars to work with. We've got a 5-minute chart here, and let's go back and look at those same two areas. Well, here was that break above and a pullback, breached the 10 period, but still held that 20 period. A little cleaner, less noise. And then again, that same one breached the 10 period, but again held that 20 period. That's something that'll keep us confident and keep us sane in a trade. You know, if I go back again here, here's the noise breaking the 10, breaking the 20, moving up, breaking the 10, breaking the 20 again. So a lot of twisted moving averages, not a lot of semblance there. Much more cleaner looking at the day. So, you know, hopefully that's a visual that you're picking up on here, because we like to use moving averages. It certainly helps us, but moving from the 5 to the 10 has helped us keep a much better snapshot of the intraday period.
Yeah, absolutely. For you day traders, you know, out there, I can't tell you how much, you know, it has helped me. I just, you know, changed back in December, and I've seen a noticeable increase in my profits lately, just taking out the noise. And this is Microsoft, which is a relatively tame stock compared to some of the, you know, the more high volatile stocks. So it's really helped. That's just a little advice for all you who may be day trading out there. May consider switching to a longer time frame.
Okay.
And, also, guys, I noticed one guy in here. I don't know if we can send him a private message, but if anybody has audio problems along the way, don't be concerned. This will be available. This is recorded, and you will have access to it. So.
Yeah, more than likely it could be the audio on your end.
Yeah.
But anyhow, let's see here. So 5-minute chart to the 10-minute chart to help simplify the intraday action. Okay, so some concepts here. Swing trading versus investing. I'll let Andy kind of hit on the screen. I think he's got some good ideas here.
Yeah, this people may ask, you know, especially with the way the market's been moving lately, it's like, you know, why not just, you know, buy Apple and sit in it, you know, why not, you know, buy Nvidia, look at the move it's had, you know. Well, that's fine in the current market that we have. The market, I promise you, is not going to always be that way. And if you look over the last, and we'll take a look at it here in a minute, the chart, but you know, we're basically about the same place we were in 1999, and it wasn't only but a few months ago. We were, you know, probably about the same place we were in 1997. So if you're investing, you know, over the last, you know, 13, you know, 12, 13 years, you haven't made any money. And, you know, so I really think we could be in this for a while, because this market and this pattern that was setting up is very similar to what's called a secular, you know, bear market. And on average, they last about 17 years. There's been basically, I think, 3 secular bear markets throughout our history. You know, one, of course, in the crash in 1929 to 1949. That was about 20 years. There was one back in, let's see, 1906. It lasted, I think, until around 1920. And then there was a stagflation market that we had 1966 that lasted in 1982. So, and typically this is, you know, very similar to what you saw back then, where you had a drop, you know, in the averages of about around 40% or greater. And that's usually followed by just a big hangover, you know, where the market just is flat or declining growth, and you just nothing really happening. You churn for about 17 years. Well, if this plays out, you know, for the 17 years, we may have another 5, you know, years. A lot of people believe this started around, you know, the year of the .com bust in 2000. So this could last longer. I'm not saying it's going to. I'm not making predictions here, but if history plays out, we could be churning and just flat or down in the over the next 5 years. So I think it's important, to if you really want to maximize your profits, is over the long term, you really have to be willing to trade in and out of the stock market.
And we can probably see a good example here in this chart to kind of illustrate what Andy just hit on. This is going back to 1999. This is a monthly chart of the S&P or the spiders. And you can see it's been kind of a roller coaster ride. You may have heard in the news some people, more so back here, were complaining that their 401ks have not grown at all in the last 10 years. And you can see why. We had a nice bull run into the 2000, the dot-com bubble busted. You can see right here we had 9/11. We tried to recover from 9/11 and still it just wasn't good enough. And then we had the bottoming process where the Greenspan and the Fed decided to pretty much lower rates down to zero and created a liquidity-driven rally back here that lasted a few years within this longer-term range that we've got going here with 10 years so far. And then we come to the housing crisis and 2008, Lehman, Bear Stearns, and the collapse, back to a down market, and we've recovered since the lows of March '09, and here we are back to this liquidity-driven rally again as the Fed is, we've got interest rates still at zero, which is the scary part, but now they're printing more money and throwing money and injecting liquidity in the form of quantitative easing, and that's been driving our markets back higher again. So again, buying and holding, back here hasn't done this person any good that has been fully invested as they wander through the decade here. So that's to Andy's point, is to being a little bit more active and in control of your own account can help maximize returns over the predicted secular bear market that I think Andy hit on there. Anything else?
No, I think you hit it good there.
Okay, this is a graphic that comes courtesy of our friend Brian at Alpha Trends, and he's going to be coming out with a scanner. We've been helping him beta test. It's a pretty cool product, and in the future we'll hit more on that. But I like this graphic that he uses. And what it does is it basically shows the breakdown of what we just looked at on that last slide, longer-term market structure and understanding the psychology of market structure. You have your accumulation stage, you've got your markup stage, you've got your distribution stage and your decline. And you can see here color-coded accumulation is just kind of a sideways action, and then you have a bull market begin to come into play here. This is called the markup stage as people start to feel good and gain trust again. And then the market stage kind of runs out of steam and becomes what's called the distribution stage, as you've got a buyer and seller battle up here, and stock and shares become distributed to new hands. And then you have the decline where the buying steam runs out and the dynamics change, and everything that worked here will no longer work in this sector here because of the general market flow. The general tide is up in the markup stage, and the general tide is down in the decline stage. So this is where you have to change your tactics. But the point of this is just showing a long-term, again, market structure as to how the markets can change, and that's one of the things we're always watching is where are we now in the current market structure. Well, again, I think we're still in this markup stage. We could be in the late markup stage, but let's go to the next slide and get kind of a better understanding. Again, this is another chart from Brian at Alpha Trends, but it's more specific in that it kind of talks about what is the mentality of the emotion of the market and the trader, and how these cycles repeat themselves. Well, down here he calls it disbelief. Nobody really believes they're coming out of a bad market where they're probably not really feeling really good about some losses. And then all of a sudden you start to get some hope where the price action moves higher and slowly moves higher and starts to bring in optimism. Typically, I would say like right around this area is where the retail investor starts to come in. The retail investor typically in history has their eyes in the rear view mirror and their foot on the accelerator. So, they're waiting for it to feel safe before they come back in. And typically that would be as the market comes to believe that, hey, well, maybe we can move out of this thing again. And then belief slowly turns to thrill. And this can be where you start to get some euphoria and or froth in the market as the retail investor continues to come in. Before you know it, the taxi driver is telling you what stock to be buying, and everybody's talking stocks. Well, that doesn't necessarily always last forever. You might be calling your wife, telling her, "Hey, honey, maybe we should be putting down payment on that lake house. This is probably going to last forever. Everybody's doing it. It's too easy." But we all know nothing lasts forever. As the distribution starts to kick in, you get some tremendous volatility and violent move back and forth as anxiety starts to set in of, are we really going to be able to continue this path? And then you have denial where people say, well, no, this is just a pullback. Everything's still cool because they've got all this history behind them, giving them confidence that we're still going to move higher. But when in fact, the price action tells you we're in denial, and then fear starts to set in, followed by panic. And then about this time, you got the guy calling his wife, telling him to cancel the bid on the lakefront property because we're just not feeling it anymore. So, here's a good example of just showing you the public's churning, the human churning of emotion, going from hope, optimism, belief, thrill, euphoria, anxiety, denial, fear, and panic back to capitulation. The retail investor starts to exit here in these stages after entering. In the belief and thrill, they start to exit, and then we go back to capitulation, and then whoever's left in the market, becomes angry and depressed, and then the cycle slowly starts to build on itself again, back to disbelief, and we can start the cycle all over again. So, literally, I think this chart here really exemplifies that. It's exactly what we've gone through in this country over the last 10 years, is this type of backdrop. All right, what else here? Okay, so this is just a quick slide. A lot of people ask us, well, what's your system? And we immediately say, well, it's not really a system, more of a method, being that a system requires constant tweaking, constant back testing, a lot of rules. If this equals that and that is greater than this, then you do this. And you stick to your system, you stick to your rules. There's no breaking those rules, and the system is very strict in that respect. We prefer to call the swing trading or swing scalping that we're going to talk about more of a method. A method has more room for real-time adjustments, whether we're talking about the market or the sector that your stock might be in. Maybe it's behaving along with the sector, or maybe it's the sector starting to turn against you. These are all things in real time that you have to pay attention to, and that's why we call it more of a method. Any thoughts on that?
Yeah, just over the years, I've had many people come to me with systems, and just be cautious, because Steve's right. In the ever-changing marketplace, these systems they work for a little while. They work until they stop working, and that's usually pretty quick. And you can lose a lot of money when they stop working, because a lot of people get stubborn and they're real technical oriented and can't see the forest of the trees, and you start asking yourself, well, wait a minute, this was working 6 weeks ago, why is it not working now? I've seen that so many times, and the good thing about a method is you can adjust, you can make adjustments, and that's something that you have to be flexible and make adjustments in this ever-changing dynamic of the market. And I think that's real important. Just be cautious anytime you hear of a system that's going to return X amount of profits for you.
Chances are chances are if that system works, it might stop working pretty quickly in the future. They don't work forever.
Exactly.
And I added this. I tell this to a lot of people. There's really only two things you can control as a trader, and this kind of goes to the psychology part of it. Because everything else is up to the market. You just don't know what's going to happen. But there's only two things that you can do to protect and keep yourself in perspective. And that is, one, a trader can only control their share size. Nobody else can control that for you but you. And that includes zero. That includes sitting in cash when the market is difficult and you can't find an edge. Sitting in cash is controlling your share size. You're in control of that, nobody else, and your attitude. When things go against you, it's real easy to get upset and frustrated, and that can start to tax you with mental capital. Only you can control your attitude. Everything else is up to the market, but these are the only two things that you really can control, and I just kind of want to hammer that home because I even forget that at times.
Mm-hmm.
All right.
That's a very good point. I'm glad you brought that up. Just reminded me something Jesse Livermore, once said. It said it wasn't his trading that made him millions, in the marketplace. It was his sitting, and it's very important. A lot of times, if you don't feel comfortable in the market, safe right now, for example, the market's just getting ahead of steam going. It's way overbought. If you don't feel comfortable buying these levels, be patient. Be patient. Wait for your pullback. Wait for your entry. I'm glad you put this slide in there.
Yeah, and if you happen to miss that entry that you were just speaking of, you got to check your attitude. You can start to get anxious and feel upset that you missed it. Well, I missed it, but it's going to go, and if I don't jump in here, I'm going to miss it. Well, the fact that you were late, we're going to talk about how important an entry is. If you let that attitude get the best of you and get upset and that you missed your entry, and you go chasing a stock and breaking your rules on the entry, well, that's just not good. That's something that could have been avoided. You have to be in control of your attitude and pay attention to that.
And it's difficult sometimes. I mean, the other day we missed one on the solars, yeah, because they took off in the first 15 minutes, and it's usually our method is to not get caught up in the early, but we had a really good especially Steve had a good feeling that the soul was going to take off, and it did, and we didn't get it, and it's frustrating at times. And you got to check yourself and check your attitude and say, okay, wait, just I missed that one, I'll catch the next one.
Yeah.
The worst thing can happen is you're not going to lose. I mean, you lose any money, but you just missed one trade. But it's going to happen sometimes. You got to shake it off and just keep moving.
Exactly. Yeah, I was definitely challenged the other day when SOL ran on the open, and I was watching it so closely, but the last thing I was going to do was chase it, and that's what was so frustrating. So I had to take a deep breath and tell myself, don't exhaust your mental capital here, Steve. There's other opportunities. Just move on. So what is the method of swing scalping? You want to talk about this one?
Sure. And basically, swing scalping is looking for that setup, looking for that daily setup, slowing down the time frames. Basically what we did is we've been trading, all 5-minute and now 10-minute charts for, 13 years. And so we got a really good feel of technical analysis, what to look for. And what we've done in our swing scalping is we've applied a lot of the same concepts and strategies to our swing scalping as we did in our day trading, and we'll have some charts to show you here in a minute. But basically, we're looking for that setup, and we're taking that entry. A lot of times, we do play off the intraday charts, looking for that breakout, that volume spurt, what have you, and we're just taking that entry, and we're basically looking for. And it's not always the case, but on the average, about a 3-day move. I think our average is.
It is. It's 3 days right now. Yeah. After we'll hit on that next slide.
In our swing, in our account. So we're looking for that initial pop. Most of the time, guys, that's where you're going to get the gist of your move is going to be. And that especially on the setups we look for is going to be in the first 2 or 3 days. In some cases, it's going to be around 20-25%. In some cases, it's going to be 6 to 8%. But that's kind of the what we're looking for, and Steve came up with a real good analogy.
Oh yeah, well
analogy.
Yeah, like Andy said, we've and we'll get into the details of that, but in the Ditto account and the swing trading for the year so far, after six weeks or so of data. There's been about 30 or 33 trades taken, and the average time frame on those, if you average them out, has been 3 days. Maybe there was one trade in there that was a 1-day trade, and another trade that might have been a 7 or 8-day trade. But on the whole, averaging them out, it's been about 3 days, and that's where you can really catch the meat of the move if you get the move. And I always like visuals, and kind of came up with the idea we're surfing the market. Positioning yourself out there, surveying the landscape, getting yourself in the right position, and then catching the wave, surfing it, and then ducking out, not riding it into the shore, not staying with it the whole way, getting the move, having some fun on it, and then pop out the back side of it, jump on your board and paddle back out and look for the next setup. And doing that, I think, really just kind of keeps a good rhythm. and like Andy said, catching the meat of the move. You're never going to be perfect. You're never going to buy the bottom and sell the top. But if you can catch that good accelerated part of the move before, and we'll show you some examples, before they start pulling it back and creating the noise to consolidate and bring the price back a little bit, which inevitably happens a lot of times, you're on to the next one. You took your move, and you're on to the next wave. So we'll hit a little bit more on that. Here is an example of what like we called an old school intraday day trade. You know, this is the kind of thing that always used to work for us in the past. What we're looking at here is a 10-minute chart on the spiders, and I believe it's a 10-minute chart. I'm not sure. I think it is. Nonetheless, what we're looking at here is, you know, a simple narrow range breakout intraday on the spiders here. We have a narrow range for most of the middle of the day here, and very tight secondary range here, holding on the moving average. This setup right here just reeks of a day trade. Go down here and you look at the increase in volume, and you're wanting to set up for this trade. The nice thing about this particular chart is it had a breakout with not too much noise or pullback. It had 1, 2, 3 nice bars of run, nice little run up there, and then as you get to this area, you can see by the end of the day, we pretty much finished here. So the people that didn't take their move and get out here on an intraday day trade time frame kind of had to sit through this head fake and this head fake and that head fake and another little run, but then that run was quickly brought back by the close. So when we say the meat of the move, you're never going to be perfect. This is the meat of the move right here. Anything you want to add to this?
No, very well said. That's
okay.
I think we have a. You know.
Okay, so here is a daily chart. When we talked about taking day trading mentality and day trading the daily charts, that's kind of the swing scalping concept. So this is a daily chart. This is not a 10-minute chart here, and I'll mark this up a little bit. Again, on the daily chart, we've got a nice tight range here. This is all Terra, and here's where we start to get into, guys, some of the actual trades that we've taken. So we're very familiar with this because this was one of our better swing trades, swing scalp trades that people in Ditto Trade hopefully participated in as well. And the anatomy of this one was, well, I think we're going to come back and examine this one, aren't we?
We'll come back.
Yeah, I guess the point of this slide is, again, a nice setup on the daily chart, positioning yourself. This is the day we position ourselves right here, and then catching a really fast move. We didn't anticipate it that fast, but we rode it, and we pretty much got out the next day. This was a 2-day trade, day 1 and day 2 right there. And we'll break this trade down more in detail, but again, the point of this slide is to show you, again, here is the S&P day trade intraday 10-minute chart, nice narrow range, breaking out. Here's the meat of the move, anticipate, participate, get out, okay? Daily chart, same kind of a thing, narrow range day, anticipate, participate, get out. And that's the concept, you know, applying the day trading quick move to swing trading, taking your move and getting out. Because you can see, and we'll hit on this chart again as I said later, the people who got greedy here and held on all of a sudden had a lot of noise to deal with on the back end of this trade, on the back of this wave, if you will. And so speaking of waves, the creativity in me got the best of me. I had to kind of come. I was watching a great video on YouTube. These are screenshots taken from a YouTube of Laird Hamilton standing up on a surfboard in Hawaii, paddling around, and he's in a bay looking for waves to ride. And you know, we're talking here using the daily and the intraday setups to catch the entry rather than just the daily chart. We'll touch on that. Positioning yourself and taking your move and running. You know. To put it visually, you know, here's Laird paddling. Here comes the wave behind him. He's positioning himself. Now he's in the trade, so to speak. He's riding the wave. He's surveying the landscape, participating. The move is on here. Still riding the wave. And I've arranged these almost like a candle. You know, look at these as like maybe 3 days of trading on a chart. If these were candles moving higher from left to right on the screen. As we get deeper into the trade, here's day 3. He's looking around. What's he looking at? Well, you know, he's looking at the market. What's the general market doing? Is it still up? Is it in his favor? Is this a semiconductor stock? What are the semiconductors doing? Are they performing, or are they starting to roll over as a group? And finally, deciding it's time to get out. The wave has passed him here. It's rolled past him, and he's crashed, moving on and into the shore. He's not participating on that part. He's taken the meat of the move and he's looking back out to find where his next opportunity is. So anticipate, participate, get the meat of the move, and on to the next, because you don't want to stick around too long. In some of these things, you can take an 8 or 9% move, and if you get too greedy, you might get some of it back, and that's never fun. But again, I wanted to highlight here using the daily and intraday charts, because a lot of traditional swing trading, they really get hung up and they focus on the daily charts, looking at the daily charts and only the daily charts, and looking for trigger points on the daily charts. Well, we actually like to use the intraday charts for our triggers as when to get in and get out, and we certainly have some good examples for you on that as well. Mm-hmm. Anything else you want to hit on this slide?
No, very well said. We do that also. We don't always look, for the intraday. We see some nice daily setups, and so
True.
And we will that will be part of our game plan, and I shouldn't say game plan, but method. So we'll hit on some of those as well.
So before we get into some charts here, we're going to set the groundwork some more for the basic concept, the swing scalping concept. We talk about entry, and we will continue to talk about entry. If there's one thing you got to take away from today's session is the entry. The better the entry, the more staying power you're going to be able to have and allow you to risk 1 to make 3. Well, let's see, where's my pointer here? Risking 1 to make 3. This is, a real key point here. And without a good entry, and we'll show some bad entries too, it's very hard to risk 1 to make 3 and sit through some of the noise that's out there. I put in here swinging the bat. You got to swing the bat. You got to step up and swing the bat. There's a lot of trades that we took this year that really didn't do anything. There's a lot of 1% loser, 2% loser, 1.5% loser, flat, 1% loser. We just call those swinging the bat. We don't let them get away from us, but they're there, and we're in there participating, because if you don't swing the bat, you're never going to get on base. Looking at some of the numbers from this year so far in our swing trading service, which we make public to our subscribers. The best trade of the year so far was 17%, and the worst trade was 3%. Now that's far better than risking 3 to 1, but that's the bookend, the highest and the lowest. Some of the good trades in there were like 6%, 8%, 11%, 14%, but keeping the losers to a small degree and cutting them quickly is so difficult for so many people, yet it's so integral to having the chips fall where you want them to at the end of the month when you go back and look at your trades and look at your P&L. As we mentioned earlier in the webinar, we've done about 30 swing trade scalps in the Ditto account this year, and when we average them all out, it's about a 3-day average before we're taking our move, either getting out for a loss, small loss, flat, or a profit.
Is that 30 trades? Is that 15 in, 15 out, basically?
No, those are 30 round trips. Those are 30 round trips.
Is that for year to date, or is it since we opened?
Since year to date, this year to date.
Oh, we've been more active than I thought.
Yeah, well, there's about 25, 26 days, so it's about averaging a trade a day.
And we will do a few day trades in there. We'll talk about that. Yeah, so that would, but we'll get more to that later.
You want to talk about this next one, tighter stops?
That's with our method. That's what we're looking for. We're positioning ourselves, for a move. And when you feel like you have a really good entry, you're patient. You feel like you have a really good entry, and this is very important, guys. If the stock doesn't do what you anticipated it to do, we don't hang around very long. I'm going to jot this down so I can show you just the recent Microsoft one that we just got out of, and it still may be intact, but it didn't do what we expected it to do. So, and that's our concept. I mean, some of them are going to hang on, and you're going to get wicked out and jicked out, and it's going to move higher, and you're going to say, "Oh darn!" But there's a lot of them that's going to get away from you and go a lot lower. And what you don't want to do is turn into a hoper, and we'll hit that more. But I like to use the term stick and move. We like to stick and move. We don't want to eat up a lot of our capital, after that big push, that first 3 days that we talked about, sitting in a stock and hoping, that it's going to move sideways or maybe just bleed back a little bit and then just eventually move higher, because what that'll do a lot of times is eat up your capital. And so we like to, stick and move and then move on to the, the next trade.
Speaking of capital, there's two types of capital. There's trading capital. Before you know it, you might have 70% of your capital tied up in trades where they got away from you, and you're basically hoping. You find yourself logging onto the chat rooms, reading messages, trying to find a reason for this thing to come back. If you find yourself in that position, it's probably too late. You've got to be disciplined. But as I said, trading capital is one thing. But somebody brought up a good point in our room the other day that. Mental capital. Where's my thing here?
He's referring to our live service when he says room.
Sorry. Yeah, our live service. Somebody brought up a great concept just yesterday. Joan, she said the mental capital, expending mental capital. As I said earlier, you can only control your share size and you can control your attitude. Well, it's very hard to keep your attitude in check when stocks are going against you and you feel like you may have missed your exit and all of a sudden you become a hoper. There's only so much time in the day and only so much mental capital you can devote to yourself to looking for the next trade or looking for the next opportunity. If you're spending most of your time nursing bad positions, you're straining your mental capital and you're not trading to your best potential. I think that's a really, really important point.
And it is. And that reminds me of something Jesse Livermore once said as well. He said a losing trade never hurts you once I exit. The hurt is gone once I exit. It's the pain is when you're sitting as long as you're sitting in the stock. Once you get out, it's still going to hurt you on your P&L, but it's amazing. Same way with my day trading. Once I've just okay, I've gotten out. And I move on to the next trade. I'm done with that trade. Okay, it was a loser. It's too bad, but just get out, man. The pain will go away.
I'm going to label this a key concept. It really is. It's something that's very hard for some people, and if you find yourself doing that, like I said, logging onto Yahoo message boards, trying to find a reason why this stock should go back up, you've lost the trade. I think you need to just, like you said, take your hickey, cut your losers, move on, and increase your mental capital. That's very important. That's a key concept. The market is not always going to be an easy trending market that we've had here. And I'm not going to say it's easy. It's never trading. Trading is never easy. But we've had a market that's been pretty consistent in buying the pullbacks and moving higher with this liquidity-driven market we've talked about with quantitative easing and whatnot. So until that changes, that's what we've got. But we're not always going to have an easy trending market that moves from the left part of the screen and moves upward to the right part of the screen. And let's get into some concepts about that. This is a snapshot of last year. This actually incorporates the May flash crash. Let me get my, this is the flash crash right here, May 6th. Everybody remembers that if you were around. That was pretty dramatic, and what we call this is the tale of two tapes. This looks very familiar. This little liquidity-driven rally was kind of QE1, the first liquidity-driven rally before we had the nervousness, and actually what was bringing this down was Europe and Greece and the euro, and the crisis of debt over there. So I've circled these two different backdrops of the market. We talked a minute ago. The market's not always going to be like this. There are going to be periods where it turns into distribution and then turns into chaos on the downside, and volatility is added. And the key point is to always remember where you are in the market and how to approach. And I think Andy's got some good concepts on how to approach these two. Let me clear this. Sorry.
Yeah, it's kind of the point I made earlier is when you're that diagram he has, or the tale of two tapes on the left side of your screen there. Everything's hunky dory. You can sit in some longs for a good long period there and get some nice profits out of it, but it's not always going to be that way. And a lot of times what happens is when you get to that anarchy, like you see there on that circle in the red, that's when I was talking about, guys, when it's okay, to sit. I mean, that is just a mess. You don't have to be doing anything, and it's not to say that there can't be some opportunity in there, and we're always trying to look for it. But at the same time, I can remember during that period, I wasn't doing a whole lot, and we had our swing service up and running then, and we were swinging the bat a little bit, but we weren't doing a whole lot during that period. And it's a time where you might want to do a lot of sitting because it was very volatile. And
Just look at some of these gaps. You know, you wake up here to a giant gap up here. You wake up here to a gap down here. There were some really big overnight moves and big and intraday reversals. Look at this. People got short here, only to get reversed on here. They got short here, only to get reversed on here. I think I coined this chutes and ladders. If you guys remember that old kids board game where you roll the dice and sometimes you slide down the chutes and sometimes you climb up the ladders. You know, just looking at this market is just the VIX was high, the volatility was high. So I think the point to take away from here is the volatility and the backdrop in this stage of the market really has to tell you you should probably be doing half of the size you normally do to adjust for the volatility. And you just really got to be careful because this was a very difficult environment in which to swing trade because of the volatility and the reversals, so many reversals back and forth, giant gaps. You know, if you were caught on the wrong side of a gap down, here's a classic example here. Here's a nice move up. I think I remember this day. This was looking like it was shaping up to be a nice move higher from there. But the people that were long, boy, they got just whipsawed. And this was a very difficult environment indeed. So pay attention to the backdrop of the market. It's not always going to be a liquidity-driven rally.
No.
Okay, so now we're going to get into some of our setups, some of the actual trades that we look for. These are all trades that we have taken that are either currently open or have been taken and have been closed, and we can talk through them. So we'll give a few of them a name, and to start with, for lack of a better term for a setup, we'll just call this the momentum trade. And that's simply looking for stocks that are, like I said, moving strongly up from the left side of the chart to the right side of the chart. Nice strong trend, higher highs, higher lows, and trying to catch a good entry on a pullback. So let's look at a chart that might be a good example of a momentum trade. FTech, some of these smaller cap energy companies have just been going crazy lately, just really doing well on a percentage move type basis. And the trade in which we took, I believe, is this day right here, right? Okay, so here's what we were looking at. We've got a nice trending chart. Obviously, we've got momentum. We've got volume. Definitely volume has come into this thing. Basically, it never really breached its 20-day moving average in this area right here. And so we've got a rising 50-day, rising 20-day, rising 10-day, all fanned out perfectly. This is definitely a momentum chart. Well, how do you play this? Here's what you want to avoid. Let's start with how you don't want to play this. Sure.
I just want you to hit on because hit on that fanning concept. What
fanning?
What do you mean
by
fanning?
Yeah. We call this the yellow line. We call this the fast line because it's a 10-period moving average, and we call this the 20-period and the 50. And we've also got 100 and 150 and 200. But when the moving averages are all twisted up, like back here, there's just nothing going on. But all of a sudden, when the moving averages fan out, they all take their respective places. The 10 is above the 20, the 20 is above the 50, the 50 is above the 150, etc. So they're all fanning out on their own merits. They're not twisting. So that usually will give you a good idea of a stock that is in a momentum move when all these moving averages are accordingly stacked on top of each other, the 10, 20, 50, no twisting of those. Is that a better explanation?
Yeah, no. I'm glad you hit that because it's important because typically, almost always, when you see a strong momentum stock, like you said, that's moving from the lower left to the upper right like that, you're going to see, the fanning of the moving averages like that, and so it's always something to look for. Steve brought that to my attention years ago, and boy, I use it a lot.
So here's a trade we didn't take, but let's examine it for a second. Had the prudent trader been watching this narrow range here, which obviously we weren't at the time, and taken this trade on the range breakout, the anticipating trader, participating, riding the wave, and then jumping off before the back end of the noise comes off. 2, 3, 3.5 days here. Look at that. But that's not the trade we're looking at. We're going to look at this one right here. And before I get to that, I want to say what you don't want to be. You don't want to be this guy who buys right here. And it's so easy. Human nature, we're wired as animals to want to follow the herd. And one of the first mistakes a trader can make is waiting for it to feel safe. Well, 1, 2, 3 days, it's cleared this resistance. Well, it sure feels safe up here, but the problem is it doesn't stay safe for very long. And when we talk about hammering home the importance of an entry, the person who took an entry here, is just not going to have any staying power when the stock starts to consolidate and pull back and create noise and gather steam for its next push higher. So the point is, don't be that person that waits 3 days for green candles and good solid percentage moves before you decide, okay, well, it feels safe now. I'm going to jump in here. It's such an easy mistake to make. The better way to do that is to sit back and stalk this trade and say, well, you know what? I missed that move. That was kind of nasty there. Let's just keep an eye on this thing and see if we can find a level that makes sense, for a pullback type entry. Typically, like I said on the previous slide, maybe 3 or 4 days of pullback in a perfect world. This one had a little bit of noise, not a red candle every day. But when it got here to this key moving average.
Before you go to our trade, I want to really drive home that the point we're making. If you notice that volume he's talking about in that 3-day move right there, look at the volume. Now that's what brought this to our attention. Okay, we saw it late. We didn't want to chase, but it's really important when you see nice breakouts like that to say, well, listen, there's some momentum in this stock. Okay, this stock's on the radar now. I'm waiting for a pullback in the stock, and so that was on our radar, but we were going to be patient and wait for our entry. So I just wanted to drive home what really brought that stock to our attention, and it was definitely that volume, that momentum breakout there. So it's on the radar now. Okay, sorry.
No, sure. Good point, because I did not hit on the volume. Always looking at volume. And then even to elaborate the big move in the volume up, what you want to see to confirm that things are still intact is a declining in the volume bars as the stock shakes, consolidates, and backs and fills. And that's what we have, a decline in the volume. And then, of course, this day right here, which we'll get to in a second, confirms that big move, moving back up with volume. But where did we take this entry? Again, Andy said we started to notice the stock in here. Stalking, as to use for lack of a better word, stalking the stock for a proper entry. And here's where it kind of caught our eye. Using this particular candle here with the spike down and the spike back up, I like it. We both like it when a stock trades through their 10-period moving average like it did. We like to see it touch. And there's something about these stocks, it seems like these days, they're almost OCD. They want to come back and touch either at a support price level, a key level, an inflection pivot point, or they want to come back and touch these moving averages. And in this case, we got a confirmation, touch the moving average, and most importantly, when you see these wicks, it's a rejection wick to the sellers. It rejected the price down here and pushed it back up and closed higher. Well, once we saw this day, it was pretty much we want to watch this thing. The next day opened up, and this is where the stock just kind of held in a narrow range that day and closed positive. It opened up at $5 and closed maybe $5.10. And this is where we took our, was it this day or the next day?
No, we took it that first one.
That day. We decided that this was the anticipation. Okay, remember we said anticipate, participate, and then jump off. Once we saw the stock was going to close like this trade was entered probably maybe an hour before the bell or a half an hour before the closing bell. Because what happens is a lot of times on these momentum trades, once you get that pullback and that setup starts to dig in, the very next day you might not get an opportunity as the bell rings. Some of these stocks can just run in the first 30 minutes and you're not mentally prepared to jump in and chase it. Like we talked about earlier, and I'm checking my attitude. There was a great trade in SOL the other day. I didn't take it the day before. It got off the radar. It got away from me on the open. And there was no way in hell I was going to chase it. And it turned out to be a good trade, but I didn't participate. So the point being is here, we took nothing was happening yet, but we were anticipating a trade that these buyers and this momentum was going to return after the noise and the backing and filling and the consolidation occurred. And luckily for us, in this case, it was a good entry. We never really had to sit too much pain, unlike the people who may have bought up here. They had to sit all this pain, all this back and forth pain. The very next day, we had a decent move, and it didn't move quickly, but that's fine. It opened lower and closed higher, indicated by the green candle there, and everything was in check. Just let this trade work for us. Well, the very next day, lo and behold, we got a nice move, and that move was confirmed by volume. So here is where we're surfing the wave, starting to look around and say, okay, what are we going to keep our eye on here to keep us in this trade? And basically, when a stock trades up through a prior level of resistance like that, many times what we'll do is we'll take off half and try and let the other half work. I can't recall in this particular trade if we took off half or all of it. Do you recall, Andy?
I think we took off all of it, and
okay.
we'll with our Ditto trade agreement we have right now, they're still working on their software, and as of right now, you know, you can't really sell half of your position, so you almost have to enter two different trades if you want to sell half. I'm working with them on that to maybe get their technology improved to where we can do more of that. But in this situation, yeah, we took that meat and took the whole position.
And I think that was like, 6 or 8, 9%. I forgot the percentage on that trade, but it was a nice push. And here we entered 1 day, 2 day, day 3. We went ahead and took our profits up here near these levels, thinking that people like this guy here who waited to buy up here would start looking at this level of resistance, the stock crossing through that level of resistance, and he might jump in here, Mr. Late Guy, and Mr. Late Guy might be buying right there, again, only to find out that he's just in time for the consolidation and the pullbacks. So we're trying to anticipate, ride the wave, don't extend our stay too long, get out while the going's good, while there's buyers in there that we can sell to. I always say I like to sell when I can, not when I have to, because when you have to sell, pretty much everybody else is thinking the same thing, and they're all running to the exits at the same time, and things happen quick, and you don't always get what you want. So trying to be counter the herd mentality, being positioned and then starting to sell when it starts to feel safe for the amateur investor, trader to come in here and take a position there. So that's the momentum philosophy behind the momentum trade. Again, I think one of the points I want to really hammer home here is if you're not willing to jump in and take an anticipated position before the bell the next day, these are the kind of trades that can get away from you very quickly on the open. And as we're going to talk about here coming up soon, we don't like to make key decisions in the first 30 or 40 minutes of the day, and we'll show you why. Mm-hmm. Anything else on this slide?
No, we hit it pretty good there.
Okay. The range breakout play. This is Vonage, and this is a chart that was snapped, I think February 1st, I think was this one. This is a few days old. But again, we're looking at a narrow range, and again, let's go back and look at the history of this one. Big spike in volume showing us there's some serious interest in this Vonage. Nice measured move down here, breakaway gap up to this level. And what I liked about this chart is it could have easily pulled back here and chopped around and came back down, but it didn't. It hung on sideways. Now, price can consolidate in two ways. It can consolidate over time, which is what I just drew there. I'm sorry, over price, pulling back in price and helping to digest and consolidate the action by a pullback in price. Or, even better, it can consolidate over time, where the price never really pulls back, but the time just goes sideways, and you get these moving averages, and the bids slowly catch up and start to catch up to this thing, and those are nice setups. Big move on good volume, sideways action. When that move breaks out, there's an anticipation trade here, and we'll go through it, that was taken on a range breakout. And again, this is an open trade, and we'll show some more charts. Anything else on this one?
No, I'll probably add to it.
Yeah, we're going to come back to this trade and some other concepts. Mm-hmm. Well, actually, we have the breakout. This was let me go back here. This was, here's where we start to marry up the daily chart and the intraday chart to use the intraday charts for timing to pull the trigger and execute the trade. What's to say really that the stock is going back up here to this resistance level? What's to say that it's not going to just drop back down into the range? Well, nothing really, but it's a setup that you want to swing the bat on, like we said, and manage the trade and take a shot. So what was it about this on the intraday 10-minute chart that we liked? Again, let's quickly take a look here. I'm sorry, I want to go back. This level here is about the 335 level, it looks like, okay? So we go into our intraday here. Here's 1, 2, 3 days of data. Here's that 335 level, that we were looking at. And this is our execution day right here. Watching the intraday price action, it came at 335, was rejected a few times, pulled back, came back up, and just showed a willingness to keep fighting this level. And here is where we anticipated the trade. I think the true breakout was 338.
It was.
We anticipated the trade right here. We said we're going to swing the bat on this one. It's looking like it's going to go. And sure enough, maybe 10, 20 minutes later, we did get the move we were looking for, and most importantly, confirmed by volume. We talked earlier in the slides about anticipating the trade on an intraday time frame. One of the things we look for, volume. volume right up here against this price level that we were watching. So, the intraday action here, lower highs, higher lows, going into that resistance level, it felt like there was something beginning to brew here, and since we were stalking the trade and watching the trade, we anticipated, and we took a 5% position at that level, which was pretty much 537, I think.
Mm-hmm. No. That was a beautiful anticipation.
Oh, that's right.
Remember, we got
530.
it was 335.
Yes. 335 right there. Go ahead.
Yeah, and a lot of people, a good question, I'm going to ask it before anybody else asks it, because people have asked me a lot of times before, well, it's not breaking out. Why are you doing it before, it's not breaking out? And that's where the anticipation comes in. When you've been, looking at charts for, basically 7 hours a day for 13 years, and it doesn't take that long. I mean, you guys can do it too. It's just you've seen it enough to where you get a good gut feeling, and I can't express, I'll take a good eye over a stack of technical, technical indicators any day, and this is a case where this is something we were stalking, and we liked the price action throughout the morning, and we just had a really good gut feeling this was going to be the day. It's going to go today, and I can't tell you anything else but gut feeling. That's what it is, and you can save yourself a lot of times. Once you see that setup, if you learn to get that strong intuition that hey, this is going to be the move, I'm willing to take a risk. And that's one reason it was 5%. It wasn't. Had I been just really convicted, it may have been more at the time. But it's worth a 5% to get in early, because if you're not watching it and it takes off, you could be the one up there buying it at 345. Oh, darn, I missed my move. What's going to go? So you saved yourself 10 cents there, and that's a big move on a $3 stock. So.
And when he says 5%, he's speaking 5% of your capital in your account,
right,
as an allocation to that trade. Let's say for a second, let me just ask the question that somebody might be writing down now. What if this trade had not worked? Where would we have put our stop? What if this trade, in other words, what if this other trade, in other words, had gone up and then failed and come back into the range? Where would we stop out?
Well, I would probably have to, if it's 5%, I'd be using the lower end of that range.
Okay, so it would be this area right here. So, when you're looking at how much capital to allocate to this, 5%, you've got to say, well, worst case scenario, what's the distance between here and here, and how much do I want to lose? I remember we want to risk 1 to make at least 3. So, you want to have a pretty good target. But at the same time, you want to have a pretty close stop that's not going to get you out too soon. Putting a stop in here, more than likely, you might just get chopped back out in the middle of the range. So you really need to allocate enough to have enough wiggle room to stop down, below that tight range.
Good point.
Okay, so there's the intraday dynamics of that one. Here's another trade that we participated in. I don't have the intraday chart of this one like the other one, but we'll just focus on it and hit on a few concepts on the daily chart. Again, we looked at this earlier in the slides. This is a narrow range breakout on the daily chart. And guys, again, the narrower the range and the longer the range stays narrow, the more confidence I have when it does break out. Narrow ranges can compress and trap a lot of energy. And when that energy does get expended, the longer the range and the more narrow the range, the more conviction I'll have when it comes out. Okay. Now, in this particular setup, we were stalking, again, kind of like that Vonage, but this one actually closed. You'll see Altera, many days of doji, doji, doji. It was so enamored and fixated on this $36 level. And for days on end in here, 36, doji, 36, 36, narrow range, fake out to the downside, fake out to the upside, doji, doji, just hanging around 36, doji, doji, doji. But right here, all of a sudden, now remember, the stock is in an uptrend, okay? Not looking to go short, but if this thing is going to start to show signs of maybe wanting to break out of this range, this might have been your first clue right here, where I'm trying to highlight that little green bar. It closed on highs, closed right at the high end of its range. The volume wasn't quite there yet, but again, it was kind of a gut feeling and anticipation, because I believe at that time the semiconductors, which is Altera, is a semiconductor, looking at that sector, was starting to get heated up again. And we thought, if this thing wants to come out of its narrow range and start to participate with its friends in the semiconductor sector, it's going to be one we want to get next to. So the very next day, we saw that this little doji day here pretty much held the higher end of this range, and we decided to take a chance. I think it was towards the close of the day. It looked like it was gonna hold up, and it was gonna close positive on the day. So again, there's taking a swing trade about 3:30 before the bell rings, half an hour before the bell rings, looking like it's going to close up okay that day. And lo and behold, the very next day we got one mother of a move. And there's a couple things I want to hit on here. This was a quick 8% move, 6-8% move, and we always talk about when you get a quick 6 or 8% move, you better start coming up with some real good reasons as to why you should stick around for more and be greedy.
Good point.
I want to talk about an email somebody sent me at the end of the day. We actually sold this near the highs of the day, and somebody sent me an email and they said, in the past, Steve, you guys would sell half or maybe even sell all just as you got above these critical levels, like we talked earlier, as the people who feel safe start to jump in. And that was a great question. He said, how did you guys know to hold on that day? Well, there was a couple things going on, really. Mainly, I'd never seen the semiconductors that particular day have the move that they did. The whole sector was up huge. I mean, every semiconductor stock we looked at was having an unbelievable banner day. And that in itself kind of gave us confidence when this stock was approaching this resistance level here, about 38.10, I'll call it. We decided that, we're going to roll the dice on this one. And we're going to roll the dice because our gut is telling us that this thing has got some more fuel in it. Two reasons. Like I said, the semiconductors were absolutely on fire. You couldn't pick one that wasn't up at least 4 or 5% that day. And also coming out of this tight range. We had some good volume exploding into it too. So for whatever reason, our gut was telling us do not sell half, which many times we will do, sell at least half or maybe even exit the position as you move through these resistance levels to avoid the subsequent noise. So my point was, I answered the guy in the email that it was pretty much a semiconductor blowout day, and we felt like we might be leaving some on the table had we exited half our position at that typical inflection point. You want to add something, because I got some more things.
Yeah, I want to reiterate that too, because that's a very important what you just added there. Don't always just take a stock on its own merits. You really need to look around and ask yourself, what's the sector doing? What's the market doing? There's a lot of things to look at. We many times will discuss, in our weekly webinars, on its own merits, the stock doesn't look that bad. But let's take a look over here at the semiconductors. Let's take a look at the oil drillers. So always be aware of what the stocks in the sector, the same sector, is doing, and obviously always be aware of what the market's doing. Is the market overbought? Is the market oversold? And we'll hit on that more about when we get into managing your trades. Okay, Steve. I think we may have lost Steve here. Just hold on just a minute. Maybe having some GoToMeeting issues. Okay, never mind. Take a little break there. So I'll talk. Talk a little bit more about that. Getting back to this, unfortunately, I can't use my cursor here, but I think what I'll talk about here is a little bit about getting back to using that 2 to 3 day move there, and look what happened after that. I mean, you can sit around and guess, oh man, am I leaving something on the table here? Is this thing going to move higher? But once we, like Steve said, once we get that 6 to 8% move. And what we'll do a lot of times, guys, is we'll start watching the intraday then. And if we see any pattern of weakness in the intraday, we're belling. And yeah, sometimes the stock, we had a trade in Dean Foods that ended up going higher, and sometimes they're going to do that. HTY recently went, and you're going to slap yourself and say, darn, But trust me, in a lot of cases, more than not, you're going to see what you see there in Altera, where they're going to get sloppy, consolidate, pull back, and we don't want to miss any opportunity costs, sitting and hoping that this thing's going to dig in and move higher.
And I'll just add, there's really nothing worse than being so proud of yourself for riding this wave and having a good eye and a good setup and participating and anticipating and participating. But there's nothing worse than the feeling of lost profits, when you're on the back end, the broken backside of these moves. More often than not, these moves are going to have some sort of a counter behind them. And actually what I want to talk a little bit about here is, let me actually hang on a second here. Let me clear these lines. Okay. This is another key concept. I didn't write it down, but I want you guys to kind of imprint on it. And we talk a lot about it in our live service. I've noticed over the years when stocks have a big candle in either direction, up or down, the day following, you're going to get a narrow range day, or a day, as you can see here, that opened and closed pretty much in the same spot. This is so common. You can see it happen over here too. A nice big green move upward, and then we call it kind of a doji, where you close and open in the same spot. There's something about market dynamics after a big day that the next day the market wants to see if it was for real or not. So you have this battle between buyers and sellers, and it's so common to wind up in a narrow range day. And I'm to the point now where I almost expect it. I almost expect after a big move that the following day is going to be a narrow range and may close similar to where it opened, not without throwing a few elbows to the upside and the downside, but for the most part closing where it opened. And I use that second day as a key if I'm still in this trade as to what to do with the stock. There are, and I'll talk about it later, some slides coming up, a scenario I call it go, pause, go, where you have the go, the very next day you'll have a pause, and then hopefully another go. But if you don't get that, more than likely you're going to start to drop back into digestion, backing and filling, and consolidation. So I will use this second day's doji to key off of, and in this case, if we had not gotten out of this trade, once it took out this low, if the conditions were right, you probably would have been wise to sell it, because more often than not, this pattern, if it doesn't go, pause, and go, it's going to go, pause, and consolidate. And I just wanted to kind of to hammer that home. That's something I've been paying a lot of attention to over the years. After a big day, I always really, for the most part, anticipate a narrow range day the following day.
Mm-hmm. Very good point. Steve was the one that brought that to my attention years ago, and boy, I can't tell you how many times that has played out.
Actually, this is kind of off the record here, but this little pattern here is a new one I'm calling it the propeller. Basically, the stock goes nowhere. It closes on this day, opens and closes on this day, opens and closes on this day, but you can see a big wick to the upside, blast out those people, reverse, big wick to the downside, blast out those people, and just return to the norm. This is something I'm seeing more and more of, and it's all due to high-frequency trading, guys. This is high-frequency trading showing itself up on the daily chart. And so these are just so... when I see these, they're annoying. They're so distracting. But I call it the propeller because you got like a propeller on the upside and the downside looking at a plane. Anyway, that's a side note. Okay, we're still on the topic here of what setups are we looking for. We talked about buying the momentum pullbacks, the momentum stocks on the pullback. We talked about buying the narrow range breakouts. And we're going to now talk about a third setup here, buying the support levels. Not so much looking at moving averages or trends, but more support levels. And this is a pretty good trade that Andy actually found this one, so I'll let him maybe set it up.
Yeah, well, first off, I want to talk about a trade that we took back in mid-December there on this stock.
Right.
Yeah, around the, I believe it was
this day right there.
Yeah, on that day. Yeah, on that day right there. And we actually sat in this for a while because we really had no reason to get out. We kept trying to sell off and kept popping back. You can see the little. It would go to lows, and then finally we got a move right there, and this was in the Ditto trade account, and we had a target out there and had our position set out there at 399 that day, and you can see it ran up there to 4, kissed it, and then finished close to lows down there. So at the time we think, oh man, great trade, huge percentage winner, and but then it dug in and ended up really having an explosive move over the next month. And unfortunately, we didn't swing trade it. We day traded it a lot, but so we kind of missed it. It was overbought for a while. We didn't want to chase, so it was on our radar. And if you'll look there around late January, it had a big gap down on some what people thought was some really bad negative news. dug in around that 4 level. As it gapped down, it sold off, and then had a little pop, closed not too far from highs. I guess middle high there, and so it's on the radar now. Okay, we want to see what this thing's going to do if it does pull back, because that was a big volume day there.
We knew $4 was a big level. Okay, on the
Mm-hmm.
upside.
Yeah, you have support there. If you go back there, yeah, mid-December, so $4 is a critical support level. So we're stalking it. It had that one day, and then it pulled back 3 days, and actually it finished kind of near the lows on that day right there he's pointing at. And so it's on the radar. We're saying, okay, we're watching this. If this thing gets back up, anywhere around that 4 level, we're going to be stalking it really hard. And I believe we have an intraday chart on this one coming up. If not, I'll just...
It's right there.
And there it is. Yep. So we're stalking this thing, and we're watching it. We like the price action there on the 31st, and we get, I'm telling Steve, I'm watching this, I'm day trading it, and I'm looking at it and say this is one we probably want to buy on our swing if this thing gets above 4. So we actually anticipated this one, gut feeling, and we bought that thing at 4. And lo and behold, look at the volume bar down there when it poked through there. It's the highest volume bar of the day. So it pokes through that key support level of $4. We're in. We're happy. We got a great entry, and it continues to move higher and close not far from highs on the day. And the next day, very next day, we get that move we always talk about, that that following day momentum move where it held support, and we get an explosive move there. And I think we sold that day at 468, and we had a target on this one. I didn't. The news that was out there was still kind of, we'll talk a little bit about fundamentals, but Steve's drawing the lines there where our target was. You can also see the 10-period moving average. That was a huge. What was the percentage gain on that, Steve? It's like 17, I believe.
It was 17, yes, correct.
Yeah. So once again, and honestly, guys, this thing ended up going higher, but once you get to a certain level, and 17 is a huge percentage gain no matter how you slice it, and we start looking for any weakness. And if it goes back to that intraday, you'll see the weakness there. After it reached our target, I don't want to sit there and risk this thing all the way back down to 440. You're giving away half your profits there. So we get our percentage move. We bang it out. We can always re-enter it if we want to. And
I think we got out like 68.
68. That's exactly where we got out. So we took our money, we hit it, we took our money and run. This is one where we end up going higher, and we say darn, and we shake it off and move on to the next.
One more thing on the daily chart on this one, we'll hit on some other ones, and we're going to talk a little bit about it, is we're calling it like the double dip. Let me erase these lines. And this is something that we're seeing a lot of on support level plays. We know that 4 was a big support level, and these people here probably saw it as well, and they had a nice buy on one day. But what we're seeing a lot of on these pullback support levels is the mentality of trying to shake the will of the first people. I call it, second mouse gets the cheese, the second bird gets the worm, what have you. We're seeing a lot of test, bounce, pullback, and retest. This was pretty much a retest of the $4 level. And when that held, we're seeing more and more of this, and I think this is going to be one of our key concepts here, is really pay attention to the double test, the double dips, double dipsy doodle, whatever you want to call it. And I'm going to go back to the intraday here, and I'm going to show you what it looks like on the intraday. Here's that $4 level, and you can see it tried to sell off, and just couldn't. Came back and got back above and came back to that $4 level. And again, this was that second test of $4. Basically, here's the thinking here that I think is going on in the market. You're basically testing the resolve of the people who bought first. They had to sit through a lot of noise, and I guarantee you some of these people that may have bought late up here just didn't have the staying power, and they got shaken out only to see that double test hold and move higher. We're seeing a lot of these double tests, and we'll have a couple more examples for you going forward.
Yeah, that's a very key. If you don't take this away from this chart, because guys, trust me, I'm seeing more and more of those double dipsy
tests,
like that. And a lot of times they will actually go and take out that prior low just by,
Mm-hmm.
whatever, 20, 30 cents, and to shake out anybody who think they caught the bottom of that move.
Sometimes they'll take
But
out that low, or sometimes they'll just
hmm
hang around in that area and bring some fear into people and try and shake the trees. But yeah, and like I said earlier, the second mouse seems to be getting the cheese a lot of times, for
hmm
lack of a better explanation.
That's right.
Okay, so there's our entry. All right, so again, key concept, entry by far is the most important element that we feel in swing trading or swing scalping, because it allows you to have more staying power, and it allows you, if you're wrong, to be able to minimize your losers. Like we talked about, our biggest losers, 3%, and there's many smaller ones in there, 1, 2, 2.5, 1.5% flats. You can't be able to afford that luxury of swinging the bat and getting out relatively unscathed if you're wrong, if your entry is poor. If you're that guy buying late, waiting for 3 days of green before you feel safe, you don't want to be that guy. So we talked about looking for volume to confirm our intraday entries, reversals from key shakeout points. We're going to show some charts that kind of talk about this. Limit bids or silly bids, we call those, looking at the daily chart and just putting in, a bid for a stock that would be kind of a contrarian entry, and we'll look at that as well. What am I missing here?
No, you're hitting them all. Yeah, that we'll talk more about those silly bids. It works really well in this liquidity-driven market, because the market is being bid, and a lot of times, boy, if you can catch those things down. Once again, guys, I want this entry concept. I can't express strong enough how important the entry is. I compare it, a good analogy is what makes a restaurant, successful. You hear location, location, location. Well, I like to use that analogy when I'm referring to an entry. What makes a trade successful? Entry, entry, entry. It's all about the entry, and I can't express that hard enough. So,
I'm sorry, this bottom bullet point here, using intraday alerts for pullbacks and breakouts. Most softwares should have the ability to give you a real-time alert. And when Andy says, "Oh, we saw this particular stock and we started watching it over the course of a couple of days and keeping an eye on it." Well, one of the days you watch it and keep an eye on it is setting a reminder for yourself. Otherwise, you're going to forget. And so we found one of the easiest ways to do that is just to set simple price alerts, whether they're breakouts to the upside you want to be aware of, or whether it's pullback to a key level you've been stalking on the daily chart. The best way, because when you're trading, your mind is going 9 different directions at once. It's too hard to keep track of all the things you want to keep track of. So just using a simple price alert feature on most software to trigger when a stock gets to a certain level, pops it up, brings it to your attention on your screen, and then you can bring it up and look at it and assess the stock in real time, assess what the market's doing in real time, assess what the sector that stock belongs to is doing in real time, and start to form an opinion of whether or not you want to position yourself and anticipate a move. So using alerts to bring
and
the stock to your
a
attention.
lot of you guys, exactly, and guys, a lot of you guys who may work, who may hold down a regular job, and if you're at a computer, like Steve just said, most softwares will have these alerting programs in it. I know all your major online brokers will have it, and throw them in there. Look for entries that you like, and if it gets there, you pull it up, and Steve said, assess it, and use your judgment, and look at the volume, and you may find some really good entries.
Okay. Let's see here. Okay, we're on a chart now, and this is actually a trade that was just taken on Friday. This is a very fresh chart. This is the way Walmart is closed. If you look at Walmart this weekend, this is the chart you're going to see. So here we are in an open position, and well, what did we see on this chart? We see a couple things. We saw a nice move on good volume, and I see that I feel sorry for the people that saw this move, and I feel sorry for them that bought right here because they were chasing the action. They weren't anticipating and positioning. I see another thing. I see the day after a big move, what do we have? Look at this, a narrow range, not so much a narrow range day, but a doji. We closed very similar to where we opened. After throwing some elbows to the upside, throwing some elbows to the downside, we had a stalemate. Very typical after a big explosive move like that. But I recall Walmart when it was doing this, and I wanted to participate, but we basically just kept an eye on it. And I don't know if we set an alert, but whatnot. When we came to the stock yesterday on Friday, retail sector was the leading sector of the day yesterday, so paying attention to the sector, definitely a green light in retail. Walmart is got its moving averages fanned out here. We got the 10 above the 20, and the 20 above the 50, and so on and so on. It seems to be making a move, actually, probably from a more of a longer-term range breakout here in Walmart. So timing the entry, well, there's a couple things that we notice here. We had 2 good days of pullback. We'd like to see at least 3 or 4 days of selling. Well, there's a 3rd day, kind of a doji day, 4th day of some more selling, and then the 5th day, double dip. We actually got the moving average to go down and trade through that 20-day moving average. And here's what I like. When I see a stock go down like this and pop all the way back up, my friend Brian Shannon says, that which doesn't kill it just made it stronger. And I fully believe that on these kind of type of charts. This was a rejection of the sellers. They tried to break it down, but it was rejected. And Andy also identified kind of a double dip there in this area. You know, here was kind of a level of support. These people may have bought after 2 days of selling, and then they were tested again on the second test. The second mouse got the cheese on this one because we kind of identified it as 4 or 5 days of good selling. Got kind of a double dip there, trying to shake out the people that bought here, test their resolve, a nice wick to the upside, another nice wick to the upside, and this is where we took the entry pretty much with an hour to go in the trading day on Friday. Like these 2 wicks here and here, price rejection to the downside, closing near highs. I think this one might be ready for another leg up. And our price target, you know, will be to start paying attention to the stock. If, you know, big if, knock on wood, if we can get this stock back up to the 58 level, we'll start paying attention to it, being positioned and anticipated down here, what to do with it when we get up here. We may sell half, we may sell it all, we may never get there.
Right.
Okay, now here is the intraday of that same trade, so we'll talk about a little bit, zoom in here and look at the events that triggered the move. In this case, we've got a nice tight range. We could see through the intraday chart here that 56 was, well, a pretty important level for some reason. There was some resistance here at 56, and that was the level we were watching. And going into the close, we had a nice break above. And look at the confirmation, the volume. Our confirmation of volume starts to increase here, moving up as we're breaking out of a nice tight range. So we've married up the daily chart of Walmart at 56 being kind of an inflection point here. We closed above 56, or we traded above 56, I should say, and we took the trade right here at 56.04. Mm-hmm. And here's a concept I also like to throw out there. Let's say Walmart got up to 56.10, and you thought, oh no, I missed it. I don't want to chase those 10 cents. Well, use high-frequency trading to your advantage. Look at what they did here. They basically moved this thing up 9 cents and pull it back 8 cents. Move it up 10 cents, pull it back 9 cents. Move it up 12 cents, pull it back 12 cents.
10 cents, yeah.
So, you know, if you still like the entry and you feel you missed it, you know, you don't have to chase it here. More often than not, we'll just throw a bid back in and know that the noise and the back and forth noise that some of these stocks have, you might get a second chance to get a better 10-cent better entry if you just throw a bid in down here. That wasn't the case for us. We bought 4 cents above on that first push because, you know, I would have liked to have seen it move higher, but it didn't. But the point is it closed above 56. We closed above that inflection point. We've anticipated the trade. We're in it for Monday. I'd love to see this stock open up on Monday and just rip in the first 30 minutes and not give anybody really a chance to get their price or get a pullback. And if that's the case, then we'll know that we're hooked up and we got the action we were looking for, and just sit tight. Don't stare at it. Let it work for you.
Exactly.
Hopefully that's going to be the case. Anything else on this chart?
No. I think you hit it pretty good. Going back, guys, a lot of times I'll tell Steve, you know, that's, you know, it's a good entry, regardless of what happens to the trade. You know, it's a good entry. I'm not gonna, if this thing, you know, goes down, takes out the you know, the lows from 2 days ago, and we get stopped out, I don't, that doesn't bother me because I know I like my entry regardless. You know, so
where is the stop on this one?
That's a tough one. You know, Walmart. The thing about Walmart is it's a fickle little stock, man. I never day trade it. It's just crazy, man. And so. it's, I think worst case scenario is, the lows from
20.
2 days ago. Yeah, but I think probably, if it breaks that 20 period again, it
Yeah,
maybe
that's that line right there.
on that.
I don't really want to see it break that 20 period moving average, quite honestly.
It's going back. It's going back, and the stock not doing. This is a chart. This is a setup we like. Okay, is it going to do what we expect it to do? Okay, we do not expect it to go back and break that to that 20. So, opportunity costs. We don't want to question. Oh, is it going to go down there and catch the 55 and bounce out? No, it's not doing what we expect it to do. So we keep tight stops on those.
And we have an example of a good trade that did that coming up here pretty soon. Okay, so there's the Walmart entry again, using the 10-minute chart. Less noise, good volume, range breakout. Anticipate, hopefully Monday we'll get our move. Stalking the buy point here. Again, I've highlighted that square. This is an actual trade in Joe Z. And by the way, we're not against trading, mid-cap stocks and stocks above 50. I know some of these examples are stocks below $5, but lately, make hay while the sun shines. Some of these lower cap stocks have been putting in some really nice percentage gains throughout the day. It's much easier, in my opinion, to get a 10% move in a momentum stock that's under $6 or $5 than it is to get a 10% move in Apple or Google or Walmart. And there's a time to do it and there's a time not to. Some of these stocks can get frothy and start to come out of the basement, and then there'll be a time when these small caps start to fail and just roll back over, and we won't be looking at them as much. But for now, they're still in play. So this is another entry. It's not as recent, but it was a trade in Joe Z that was taken for our swing service last year, and it's really just almost a textbook. It's very pretty. Nice upward move on volume on the daily chart there. This is kind of a momentum stock. We've got all our moving averages fanned out here. Don't want to be the guy who's buying up here. We don't want to be that guy. We want to wait for the noise to shake out, wait for this move to consolidate. We had 1 rejection sell day, 2 sell days, 3 sell days, 4 days of red selling, and we're back at this inflection point of 250 here. This was a trade that, in this particular case, we did not take it on this green day. In some cases we might have, but we didn't see any reason, and I'll show you the chart here in a second, to enter the trade on this green day. We actually waited for a bar reversal and confirmation and participated here. And this is what the chart looked like on that day, intraday. This is the day where it closed barely green on the close, a little volume coming in, but we didn't take a position. The very next day we had a price alert, I believe, set. And we were watching it. Did we anticipate this one, or did we buy it right at 255?
We did. We bid it right around 54, 55. It's been a while, but I do remember jumping on that one early. Just the volume started coming in and going back to the gut feeling.
So, here's your 2 time frames lining up. Let me get this slide back. Okay. Nice daily chart. Everything pulling back to the fast line, the narrow range bars starting to get narrow, digging into the support of 250, holding on to that 10-day moving average, showing some signs of life, and as soon as you take out the highs of that little green bar there, it was on. You can see here, nice narrow range day of that day and a half. Anticipate, volume confirms, and the trade was on right there.
Yeah, that was one of our better trades last year. That was a good one.
And
going back to that, look at the the fanning out of the averages there. Once it took off from that prior breakout around the 220 level, and it started fanning out, and your upward sloping 10 period moving average. That's in momentum trades. That's what you want to look for. It's a nice upward sloping 10 period moving average.
And I think we held through. We held through this day, and it was the next day that we started to take profits. Again, getting through these prior highs, it starts to get a little dicey up here. More than likely, I think we sold half right here, and let the other half run and just manage the other half. Okay. All right. How to position? What size to take? How to position? What position size to take? Well, there's a couple things to check yourself on how to position yourself, or how much to allocate: 5%, 10%, 15%, 20%. First would be, what's your conviction level? How sweet is the chart? How sweet is the setup? Is it a 5-star conviction level? Well, if you really feel strongly about it, then you probably want to add a little extra weight to it. If you're not feeling that strongly about it, maybe you're the first mouse and you're afraid of being the second mouse getting the cheese, well, maybe you wouldn't take as much. How volatile is the stock? I wrote an article the other day on a new issue called SODA, Now, this thing only trades with like 60 million shares, SOTA, and it's a new issue. I'm not spelling very well. But it's only been out for about 70 or 80 days. It had a really nice setup the other day, but didn't trade a whole lot of size in it because the spreads are very wide. The stock trades very, very violently in both directions. So you got to pay attention to the personality of a stock. Is it a 1 penny spread like Citigroup or Bank of America, or is it a 15, 20-cent spread? Stocks like that, you really got to be careful of if you're going to play. You don't want to be taking big position sizes in volatile stocks, and it probably goes without saying.
Exactly.
Where is the market? We've talked a lot about in this seminar here today about where is the general market. Are we in a nice uptrend, liquidity-driven rally, or are we rolling over with high beta and high volatility, like we saw in the May flash crash? What's the market doing? Is it tired? Is it consolidating? Do you think the market's going to move higher? So always keeping in mind what the general market is doing to help you size the particular size risk to take in a trade that you're making.
Mm-hmm.
And when to add to a position, we will talk about that coming up here.
Yeah, so not only where is the market, also you can throw in there where is the stock? Is the stock overbought, oversold? And so. True. But I can't stress enough. What I go off more is gut feeling, and that comes back to the number one up there. What is your conviction level? And it's like that HDY trade the other day. Even though it was in a downtrend, it's on the lower end of its range. That was I liked the way it was setting up, and we took a 10%. And when we say 10%, it's 10% of our portfolio. So we sometimes say full position or half position. If we say half position, it's usually 5% of our portfolio. And sometimes we get aggressive. We really like sometimes get up to like 15%, 20%. But that's usually we're just in for a quick move. But and we'll talk about when to add position. This is a critical point.
Okay. Actually, I put up there fear and hope, and hoping that Andy might elaborate on the great Jesse Livermore and what he had to say about how we manage our fears and our hopes.
Oh, absolutely. This is this. I'm glad you brought that up because this is I get more emails from clients or traders who most people have trouble cutting losses, but their biggest drawback is they can't hang on to the losers and they can't add they can't hang on to the winners, or they have a hard time adding to winners. And Jesse Livermore makes a point about how the human is wired, and our brains are wired to fear when stocks go in our favor, and to hope when stocks run against us. And I can't tell you how many times I've seen that. You turn a stock starts running against you, you start hoping that it's going to come back, and a stock starts going in your favor. You start fearing that, oh no, I'm going to lose my profits. I better get out. I'm going to lose my profits. And to really be a successful and trader and to maximize your profits, you really have to reprogram the mind to think just the opposite, to where when stocks are moving in your favor, you need to be hoping that they're going to continue to go in your favor. And when stocks run against you, it's when the fear should be dominant in you, and you should be fear that it's going to continue to go lower, and you're going to lose more money, or go against you and you're going to lose more money. And I can't stress that hard enough, guys. You really, really need to reprogram your mind. And I wish I had some. Unfortunately, I'm not a psychologist. So for me, it's just what turned me around after basically 1 year of trading was the fear element. You really, this is a business. You have to treat it like a business, but it's also a game. And and I think the good traders out there, they understand that aspect, that it is a game, and you have to treat it as a game at times. And if you can lose that fear element of trading, not lose it, because you have to be aware, that it's dangerous and it can go against you, but you have to control it. So there's probably enough said on that, but anyway, I want to drive that home, because I see it so much, guys. People emailing me, man, I just cannot hang on to my winners, man. I can't add to winners. How do you do it? And
well, here's a good example. This is the Vonage chart that we looked at earlier when we only had this one spike, which was like Tuesday. Well, this is how Vonage closed out on Friday. and this is still an open position for us, and this is a position that we added to. So we thought we would talk about the anatomy of how to add to this position. There's a couple things that strike me here. Big move, okay, we had our big move, didn't really close on highs, but the very next day we got pretty much a narrow range, okay, and I was kind of expecting that. And then I will, like I said earlier in the broadcast, I will key off of that following day's narrow range to decide what to do with this. And there's a nice caveat in this one. I had said before that if it takes out the low of the narrow range, you want to look to get out and take your profits before the stock consolidates and comes back in. If the stock is able to take out the high end of that narrow range day, then chances are you're going to have some continuation. And in this case, we did get a move higher, but not without a move lower. And that's what we're going to talk about here in this next slide. Oh, actually, wait a minute. Where did we have that? Oh, there it is. It's somewhere in between. Well, I think we did that for a reason. Let me show you where we added to this position. We added to this position on Friday, and well, actually, I'm sorry, we'll go into the intraday.
That's okay. We don't need the intraday.
Yeah.
You can kind of talk using this.
Well, no, I want to have the intraday, but
okay.
we basically looked, I think, at these levels right here as if we can get back above these levels, we want to add to this sucker because this day after, this narrow range day, didn't really threaten too much, and we pretty much stayed above that the following day. But there's a point I want to hit on that, and let's see. Let's go forward. Let's do this. Let's just look at this here. Here's the intraday on that stock, and here's what we were looking at. Where was it? It was 358 that we entered?
57.
357. Okay, so basically we entered a second half of the position on a 10-minute chart right here. And before I do that, I'm going to show you one of our major rules here is we talked about, or we'll continue to talk about, avoiding making crucial decisions in the first 30 minutes of the day. This right here, guys, this is high-frequency trading, and we've seen a couple stocks, and we'll have more examples, where the opening 30 to 40, 45 minutes is an absolute train wreck. And I liken it to a basketball player coming down with a rebound and throwing mad elbows left and right, trying to clear out a space around him. And it happens so often. So learning from mistakes in the past, getting out of good trades in the first half an hour has cost some good trades. And going back and looking for what it really is, it's nothing more than just the HFT noise, high frequency trading noise, that this markets and many of these stocks take on in the first 30 or 40 minutes. So we try not to make critical decisions. What I mean by that is, I had said earlier, here's that narrow range day on the 10-minute chart prior. If we take out the narrow range day prior, then you might want to exit the swing trade. Well, it did it, but it did it in such a flash, a brief fashion. It happened so fast you couldn't even see it, and you can see it happen in the first 25, 30 minutes of the market here. So one of our rules that we can kind of augment as we go, having the flexibility of a method rather than a system, is to look at this and say, well, more often than not, when we're in a good trade, these types of shakeouts will occur in the first 45 minutes of the day, and that's all it was. It's still a good trade, as you can see, but the attempt to shake out the traders here has been the most difficult adjustment to try and avoid. So therefore, we've kind of coined a rule that says this period of each day, we're going to try not to make too many rash, critical decisions on entry, exiting, or even adding. So that being said, here we are in the middle of the day. Good volume on the close prior, good volume on this day, showing some good volume. We identified this 358 level as a place that seems to have raising lower, higher lows there. This could be another inflection point in which to add, and we did. So we got confirmation by the volume. We added a second 5% to this trade. It's now a full position, 10% trade, and you saw that it's open, and we'll be hopefully having some good stuff on Monday to talk about this trade. But I need to go backwards a slide now. Okay, so we talked about avoiding the first 30 to 40 minutes when making crucial key decisions on entry or exit and not getting shaken out by the trees. The market is becoming an absolute master at shaking the trees, and this is a key concept here. First 30 to 40 minutes, be so aware of making critical decisions, because that is the witching period where these algorithms are shaking the market and throwing elbows.
And that's why we wanted to talk so much on the high frequency trading, in the first part of this webinar, because it is an element that you have to deal with even when it comes to swing trades.
The double dip phenomenon, buying a base. We saw that in HDY. We saw that in the Walmart. It's an observation as of late that more and more the second mouse seems to be getting the cheese. So, try and take that away with you and keep aware of that. If you're the person that bought that first pullback and is starting to roll back over, we're getting to the point, Andy and I now, where we're just saying, okay, we're probably wrong here. We're probably early. Where does this thing want to go? Do we want to risk it? Do we want to sit through the second test? And more often than not, we don't. We don't want to stick around and sit through that second test. Maybe we'll ditch it and come back to it and revisit it. But there's been a couple of trades we've gotten out of because we were too early. We were the first mouse in certain setups. Letting a great entry in a positive trade roll over and go negative. This is a solid rule. I'm going to show you an example of this, and that actually happened to us. There's absolutely no excuse for spending so much time on your entry, studying your entry, participating, and getting the move. And actually, I'm talking about getting a confirmation where the next day it's green and it's going in your favor. There's never, ever an excuse to let that trade roll over and go back negative on you because, it's not working out the way you planned it. And you never really know the reason why. You just have to kind of shoot first and ask questions later and stick to your rules. And again, we'll have an example on that. And another thing, a mistake, this is under mistakes to avoid, by the way, here, just some things we've learned over the years. When we're swing trading, right now we're in the peak of earnings season, and every trade I take, the first thing I do, or before we take a trade, the first thing I do is I check the earnings calendar. You don't want to get into a trade and be surprised that earnings are tomorrow and you didn't catch it, or earnings are that day and you didn't catch it. Or even worse, far, far worse, is gambling on a trade. Maybe you're having a weak month and you think you see something and the drug addict in you is itching to really get a good move. I shouldn't say drug addict, but the addict in you is really trying to get a good move, and so you're going to double up and take a gamble. I'm calling it a gamble on going into earnings when you know it's earnings and playing those earnings. Never, we've tried it over the years, and I can't say it's been a good experience. More often than not, you're going to lose control over a trade, and it's not going to work out the way you want it to. No, we just don't believe in throwing caution to the wind and taking a trade into earnings when you know there's earnings, because anything can happen. And we'll show you a chart of that. So here's some examples of the slide we just talked about. This is CSIQ. It's a solar from last year. It's an old screenshot, but you can see I've circled the first 35, 40 minutes. This is a 5-minute chart, by the way. Look at the noise here. Opens up strong, wick down. This is high frequency trading at its best right here, okay? On the upside, on the downside, throwing elbows, and then the stock slowly starts to gather itself. And this is about the time of day where we start making our decisions, letting this noise. This is a key concept here, letting this noise in any stock, just about any stock these days, filter itself out as the algorithms come into the day, start making markets. Remember, they didn't. They're just joining the fray here. They're going to participate, the algorithms, at the beginning of the day, and they're going to participate throughout the day, and they're going to get out. They're not going to take risk home. So every day on the open is a crazy slam dance of algorithms coming in. So you've really got to be careful of this first period of the day. And I think I have a second chart. There's a second chart showing the same thing. First period of the day. Oh, that's the same chart. I'm sorry. Mm-hmm. Okay, here's another chart. Again, opening range of the day is very difficult, and we want to avoid making crucial decisions in the first 30 to 40 minutes. Now, I know it's a hard concept to not want to have a stop open, and sometimes what we've done is we've actually canceled our stop to try not to get wicked out or stopped out on the open, and more often than not, that's kind of helped. Removing the hard stop and just managing it manually, because more often than not, by the time you even freak out and pull up the stock, a move like this, can be counteracted and swept right back up. This is designed, nothing more. These algorithms are preying on stop orders, and it's almost like the people who program these algorithms know where the weaknesses of the emotions of the human traders are, and in the first 30 minutes they can really exploit those. Okay, here's an example of another double dip we talked about. Maybe the second mouse getting the cheese. Here's a nice momentum play. This is AMAT, a great semiconductor as of late. Got the moving averages all fanned out for the most part. A nice momentum trade. So you would think after a nice 3 or 4 days of pullback here that this would have been a good entry, or at least this day right here as it starts to hop off that moving average. You can see it traded up and then closed right back down. The next day traded up but didn't really go anywhere. And then the third day rolled back over, really, and took out, you can't see it here, but this low is 5 cents lower than the people who bought here. So they literally shook the trees here. And I guarantee you some people that were loose hands or not very strong hands, weak hands, coughed up some shares on this double dip here. The second mouse got the cheese, and you can see what happened from there.
Good one.
Okay. And again, this was the Walmart trade that we looked at, but we threw it back in here again for a second example of people maybe buying these supports here just a day early as the market tried to shake the trees and complete this moving average touch before connecting and trying to close back above 56. Okay.
It'll be interesting to see how that plays out.
I think we're going to look at Microsoft too when we go to the live charts
here.
Yeah, that's a good double dip that's in real time shaping up. Okay, earnings season. I told you guys if you know earnings are coming in, I just don't understand the people who last week were trading power into earnings. Yes, it has a high short interest. The amount of traders holding positions in the stock, I think at least 40% of them were short. And as they were back here, this was the first time they had earnings. You can see the stock is telegraphing this thing does not want to go up. Earnings, bad. Even though their earnings weren't that bad, the reaction to their earnings was pretty bad. There's a lot of shorts in the stock. Well, I do feel sorry for the people that, after watching all this, knew that power was coming into earnings again and got enamored with this day, and this day, and talked themselves into the fact that this thing had a big short float. And they were going to roll the dice and gamble and go into earnings. Well, they were absolutely crushed and severely punished. There's just no excuse for playing a stock into earnings, and we just want to point that out. It's not our intention. We're never going to do it in ditto trade or swing scalping. It's not a part of our method. It's just not going to happen.
No.
Okay, we talked earlier, guys, about don't let a good entry go bad. When you've got the right setup, you've got the right entry, you get the stock going for you in your direction, and then something changes. It's never fun, but this happened to us about a week and a half ago in Marvell. Marvell being a semiconductor stock, the sector was very strong. Obviously, we weren't going to be being the guy who bought up here after 10 or 11 days of solid run-up. We started stocking the stock down here. Kind of a double dip in this one, too. It bounced off 28. You can see 28 has been kind of an inflection point going back on last couple months. Got close to it, actually touched it here, and then started to trade back up. Well, it wasn't quite ready. It went lower, shook the trees, came down, touched its 50-day moving average, and then popped back up. The very next day, traded down in the morning, and then popped back up, and then this is where we took our entry on the close of this day right here. We felt that these two wicks had double tested. We'd shaken the trees enough that this might be a good entry in a good semiconductor sector. The very next day, the stock opened. Here we are. We're in the money. We're actually up a couple of percent as of here. And the stock closes off its highs. No big deal. We're looking for more movement the next day. But the next day we opened up, and this is Egypt day. This is when Cairo exploded, okay? So, shoot first, ask questions later. The stock rolled over and never caught a bid all day long. It just kept trading lower and lower and lower. Now, originally, our stop was down here. But once we saw that we had a good entry, the trade was working in our favor, something wasn't right in the market, we can't just sit here and let this thing go back to lows. Our rule, as we said earlier, was not to let a good trade and a good entry go bad. And so we flatted this trade and got out.
Got out, yeah.
And look how much it saved us.
Yep.
So that's a good example of it's just one of our rules. If you check one, good entry. Check two, stock starts moving in your direction. If it rolls back over, don't ask questions.
No, just get out. Good point.
Okay, managing the trades. We talked a lot about this. Knowing your initial target. Yeah, knowing your initial target and stop loss here. I think Andy has some comments on that when you get in a trade initially.
Oh yeah, well, basically, yeah. We kind of touched on it there with Marvell, and what we'd like to do is we put initial in there. We like to use kind of stop areas. We don't We don't like to use exact, points. A lot of people say, well, your stop point, and there's nothing wrong with that. That's just their way of doing things. I like to kind of pick an area because there's much more than just, like I said, the stock's own merits that's going to dictate, what we do once it gets to that area. So, we want to know, what's the market doing? Is it just a shakeout? Is the sector holding up? There's a lot of things that go in that. But I think the point and reason we put this in here is the word initial. Okay, you may have when you enter a trade, you may have a target and a stop, but as the trade moves in your favor, or well, we're just going to use that scenario because it's moving against you. You're going to leave your stop in there and get stopped out. But as it moves in your favor, you need to raise up your targets. Or not your targets, but maybe your targets, but most definitely your stop. You don't need to, if you get, like we just showed in Marvell, you get a 2% move. There's no reason to let that stock, go against you and you lose 1.5% on the downside after being up 2%. So just lift your stops, higher, and also you can do the targets. Kind of like we did in the Altera trade we just showed you back. The sector was really strong, and it was getting to a key resistance level, but the market was strong. The sector was just exploding, so we raised our target up on that one. Instead of making 3.5%, we made 6.5%. So just be flexible and be willing to adjust your targets according to what the market is telling you and the stock's telling you and the sector's telling you.
And scaling out of a winning trade, going back to that Altera example, when a lot of people ask me, well, why didn't you sell at that first inflection resistance point? And we usually do, and I want to tell you the reason why. It's so hard to know what to do when you get up to those levels of resistance. You can really kick yourself if you hang on to all of it and the stock rolls over and you didn't bang out profits. You can really kick yourself if you sell all of it and the trade moves higher and you missed out on some profits. So what we've found over the years is when you get to those inflection points, or when you get that itchy trigger finger, like you really want to start banging some profits out, we like to sell half. And what that does is it basically just appeases your ego, appeases your mind, makes you feel like no matter what happened, either way, you're still going to come out a winner. And whatever you can do to help your ego and your psyche in this business is definitely applauded. Andy said tightening this trade stops that work for you.
I think we hit on just about all those.
Paying attention to the sector and knowing when to hedge. We'll talk a little bit more about knowing when to hedge, maybe on the back end, but we will use in times, if you've got a lot of positions open and the general market is starting to feel a little like you don't really know which direction we're going to go in, but you don't want to bang out of these trades just for the sake of getting out of them because you feel nervous, sometimes we'll add a position of SDSs, which is simply just an inverse S&P double. So if the spiders are down 2% that day, the SDSs will be a winner of 2% that particular day. So we use the SDSs as a vehicle sometimes to take as a position to offset any other open positions if we're not really sure about market direction. And back on that one screen where we showed the tale of two tapes, when the market got crazy and volatile and dicey, there was a lot more of SDS hedging going on because of the volatility and the uncertainty. Couple more charts I put together for the go, pause, go, the scenario phenomenon that I had mentioned earlier. Here's First Solar. First Solar is really good at doing it. Look at this big 3-4% move in First Solar. The very next day, look at that narrow range, and then the very next day we had a go, pause, go, and look at almost on the same vein here. We had a nice upward 4 or 5% move here. Very next day, what do we have? A narrow range. Even though it's not up near the highs, still a narrow range. So it's so common for me to see the day after a big move, a stalemate between buyers and sellers. Your open and your close are going to be very, very similar. And I think I have another chart explaining this. Yeah, and here's a situation where it could have gone both ways, okay? This is ARBA. Nice big explosion move there. Look, there's our narrow range day, the day preceding. And then I talked about if the day after the narrow range day starts to fall back in and take out the lows, more than likely it's going to signal the fact that the stock wants to return and consolidate and redigest that move. But look at this. Here's the flip side. Nice move. Here's our doji day, the preceding day. Is that right? Preceding? The day after, excuse me. Narrow range day, pretty much closes where it opens, but we get our go, pause, go versus go, pause, consolidate. So here's a chart that I found that actually showed two scenarios of the big move followed by the doji, and then using that doji to kind of key off of what you're going to do next. In this case, holding on was a good thing. In this case, the very next day broke that doji's low, get out, and it proved to be the right move. So I just want to have you guys imprint on a few of those changes. Adding to position, we talked about this. I don't know why this slide came in here as a duplicate, but we'll see how this trade works out on Monday. Again, 5% position taken here. Here. We added to the position here. And quite honestly, going back, we went back on a monthly chart. It looks like this thing could get up to, there's two levels, I think, the 377, and then we think the round number of $4 could be a good price target. So we might sit up there around 399. So hopefully that's the way this Vonage trade will go next week.
Yeah, you're saying the right word, hope. Yeah, because instead of fear there.
Again, a duplicate slide talking about the opening range chaos here. Quick thoughts on short selling. We haven't touched a lot on short selling because it hasn't been the market that we've had for the longest time. There will be a time to focus on it, but some simple thoughts right now in this environment. There's a lot of stocks being bought out. You come in on Merger Monday. Hello?
Okay.
Oh, can you hear me now?
You're there.
Okay. In this market environment, there's a lot of stocks being bought out. We're waking up to a lot of Merger Mondays, stocks popping up 18, 20%, and that's just a nightmare if you're in one of those stocks and you're trying to short them. So one of the things you can do is maybe short the sector. Home builders. We're going to take a look at home builders as a weakening sector, the XHBs. We talked about using the SDSs as a hedge. You can simply just ride the SDSs if you feel the market's weak, and not trying to pick an individual stock and falling victim to individual news in a stock. And basically, a lot of the setups we talked about today, I don't want to sound flip and cavalier, but it's really as simple as turning the chart upside down and using the same setups and the same mentality, momentum to the downside, rather than using a 4-day pullback and buying a long setting momentum setup. If there's a short momentum and all the moving averages are pointing down, you have an extreme down day, and then maybe the stock bounces up, three days of low volume bouncing back up into the moving averages. That's where we might look to set up a short sale. The same methodology on the long side, but just flip the chart upside down, flip your mind upside down. And then spotting relative weakness in certain sectors can kind of give you a clue as to what areas might be ready to be shorted if you're so inclined. We'll touch on that.
I just wanted to say right now, just for those guys, you could probably start firing away with questions now because we're kind of getting towards the end of our portion of the webinar, and then we're getting close to the question and answer. So if you'd like, if you have any questions or any stocks you want us to look at or anything at all, it's pretty much open mic, or not open mic, but open chat. So just feel free to start firing away in the question box.
Yep. And we'll hit those up as soon as we get them. And a couple of pitfalls to avoid, just some final thoughts here as we get to the final thoughts of the session. Some mistakes I see traders making and pitfalls that they should avoid is, seeking the holy grail of trading. There really is no holy grail. There really is no system that's going to work for everybody. It's an independent game. It's a subjective game. What works and the methodologies that work for some people might not work for others. So you really have to, examine yourself and your own personality and your tolerance and your risk and find out, what works best for you. But there is no holy grail of trading. I know there's a lot of people that look for it, but it's not there for many reasons. What works for one person doesn't work for others, and not to mention the market is constantly changing. Overanalysis paralysis, that's something that some people will just look for too many things to line up at once, get 9 planets all aligned at once, and the downside of that is just waiting too long, not taking a chance. Sometimes you got to take a chance. You got to anticipate, like we talk about. You got to anticipate to participate. If you're the one who's going to wait and see how it opens up tomorrow, and wait for the stochastic, and there just can be too many parameters sometimes to keep you from pulling the trigger. Try and keep it simple. Trusting the opinions of others. I will honestly tell you, I have lost a lot of money over the years having somebody come to me and say, hey, you might want to look at this stock. I know somebody who knows something's going to happen. And I've done it, and stupidly. I haven't done it in years, but I've taken tips, and they've never worked out. So you just got to think, if you're taking a tip, you're probably on the wrong end of somebody's ulterior motives. Be very, very careful about that. Not properly managing hope and fear. We really hit on that earlier, talking about hoping and fearing, what to hope and what to fear. And money management. like I said, going into earnings, maybe you had a slow month. Well, I bet the stock's gonna pop on earnings. I got a good feeling I'm gonna go in and load up. Don't double up to catch up. Don't break your rules. Don't take a 25% allocation on a trade when your gut tells you 5 or no more than 10. Just be aware of that. And that brings us kind of to the end here of what we wanted to present to you guys today. And like I said, I see some questions coming in. We'll open it up to some questions. And what I'm going to do now is I'm actually going to turn it back over to Andy. He'll have his screen up, and he can go over some screenshots, and we'll use his screen now. So let me send it to you, Andy.
Okay.
Okay, let me read the first question as we see Andy's screen. Hi, Steve and Andy. Thanks for the webinar. Lately, I've been having problems with my stops being triggered out at the penny, only before the stock bounces off and my stop is already relaxed below the support level. This may sound like a conspiracy theory, but it is as if someone, or HFT, knows about my stop at that level. They hit it before letting the stock bounce off. I have found that the alerts are becoming more helpful. By the time I check the alert, I watch closely if the price action is a fast wick or staying below the level where I will manually exit the position. I fear that this could be dangerous. Sharp drops, mental stops versus hard stops, testing my discipline. Any thoughts on this? It's a great question, Ely.
A very, very good question. It's tough, and we can sympathize with you because we've been getting stopped. The same thing has been happening to us too, and that's one reason we spent so much time this morning on high-frequency trading and algorithms. They are prevalent in the marketplace, and they are going to remain prevalent, and it's just something we're going to have to deal with. Now, there's only, two things you can do, actually. You can put much looser, stops, or you can put much tighter stops if you're going to use stops. I personally, I don't know if you're watching the market, full time. We like to use alerts, and so in other words, to alert us when we're getting near a stop level, especially in the first hour of the day. I'm trying to think of trying to think of an example that we have there, Steve. I can't really think of one off the top of my head, but.
Well, firstly, I think I think when we talked about using that first 30 or 40 minutes, that's where we kind of detach our hard stops, and we don't want to get stopped out. So I would say maybe check the time of day. I'm more inclined to let a stop trigger at the end of a day or in the middle of a day than I am inclined to have a stop in place and let it trigger and get me in the first portion. I don't know, Ellie, of your situations there, but maybe you notice when this is happening to you, maybe it's happening more in the first 40, 50 minutes of the day. That's possible. That's something that you could start to pay attention to. As we talked about the first 30, 40 minutes of the day, trying not to make crucial decisions. What you're saying, it makes perfect sense, and I feel the same way sometimes, the conspiracy theory, where they literally get you to the penny. One of the things I have been doing is I have been looking at this and saying, okay, where's my stop? Okay, nice tight stop here. Let's say, for an example, there's a support line at 50 cents. Well, I'm not going to go to 49, I'm not going to go to 48, and I'm not going to go to 47. I've been giving myself like 3 or 4 cents because I see these things in these insidious ways, and they go down and shake the trees. They will go through by a penny, 2 or even 3 cents sometimes. So I've been giving myself an extra couple cents. I don't like to do it, but I feel like I have to do it. And a couple times it has saved me, where if I'd have put my tight just a little bit tighter, they might have got me. So
I think you have to, I think you have to realize, that these designers of these algorithms, these seek and destroy programs or whatever, they understand. They're looking at humans, and where would a human put its stop at? If they're looking at this chart technically, well, this is a good level down here, and not only am I going to take it there, I'm going to take it 4 or 5 cents lower, and in some cases, depending on the volatility of the stock, it may be 30 or 40 cents lower. So what I would do in this situation, I'm not sure what kind of style, are you buying pullbacks and things like that, but what I would do would be to cut down my size and loosen up my stops, especially, in this market that we have right now, this liquidity, driven market where it's being bid, at levels. So, of course, in cases like last Friday, there's nothing you can do. If they're gonna wipe out everybody. But that stuff's going to happen. But other than that, yeah, I would recommend, basically, just cutting down my size and loosening up my stops a little bit.
I almost even literally subconsciously go like, I'm going to put in like a 38 stop. I'll put it in, and then I'll go back and change it to 37.
Yeah.
I'm erring on the side of caution and slippage to try and not get taken out as much. And if that means an extra cent or two here or there, I'm doing it. So be it. Because what I don't want to do is put it like if the low is 50 and you put it at 49 and they come back and test it, they're gonna try and drop the bid, and because they know, and it actually touches on the next question here from Mark. You touched upon it, but can you please expand on your thoughts relating to the use of stops overnight? Also, can market makers see your stop? It almost feels like they can at times see your stop, but I think what's more happening is these algorithms that they're programmed by people, but they're running on an algorithm, and more often than not, they seem to be very good at trying to get the best price they can, and they all act in collusion sometimes. It seems like you get to a certain level, and all the bids just drop at once, and it's almost a colluded effort on the algorithm programming to try and shake the trees and get people to cough up their shares below those levels. There's only a certain amount they're going to do that. They're not going to drive it down too low, but a penny or 2 or 3 cent stop below the prior support, that's the level that they're preying on. That's the level that they're looking for. And as far as your question of can you expand on your thoughts about the use of using stops overnight, we've kept stops in overnight, but I think I mentioned earlier in the program, if a stock looks like it's going to be opening up near that level, we don't want to get stopped out on the first 30 minutes of the day. There have been times where I've detached that stop and let those spikes kind of trade through. It's not easy. It's not comforting, but in my experience, it's been more beneficial than leaving the stop in there, only to be extremely frustrated that you were correct and the stock moved higher but stopped you out. You just feel like such an idiot when that happens. I know. Did you have anything to add on that one? Using stops overnight?
No. You pretty much hit it. I mean, another thing you could do when a lot of times it's kind of it's tough to do, but a lot of times what I'll do is as I'll look, I say, okay, where is this stock going to go before I'm in it? Where are they going to try to shake the trees on this thing? It's very tough to do, and just put a bid down there and look to enter that on the shaking of the trees. But the problem with that is you may be looking at a really nice chart and you may not get it. So. That's a tough one. It's one we're still grappling with, and it's just unfortunately a element of the market right now that it's going to be here for a while that we just have to deal with, and you just got to loosen things up a little bit and play smaller size, I think.
Yeah. And it was really Andy that brought that to my attention. You've heard us trade back and forth. I've brought a few things to Andy's attention. He's brought a few things to my attention over the years, and that. Looking at the clock, that first 30 to 40 minutes of the day, I'm down with him. I totally agree. That's where the damage is really occurring in a lot of these shakeouts. So, what can we do as a trader to control? We control our share size. We can control our attitude. But on the opening 30 or 40 minutes there, we have to really keep our emotions in check. And all we can do to control it is to control our how we manage our share size, and to just leave it out there and let them take it. I've seen that happen more often than not. If I leave it out there, they're going to get it, and it's going to reverse. I'm going to be mad that they got me. So they're forcing us to downsize a little bit to allow for that slippage, and forcing us to be a lot more open-minded in the first 30 or 40 minutes, because, like I said, a lot of times those spikes, they go down, they pop right back up. It's nothing but them running stops, and that's what they're looking to do. I don't know if they can see our stops, but
I don't think they can.
I don't think they can, Mark, but my point was I think they can feel where they are. They can't see them, but I think the algorithms and the markets just know where they are. They just prey on human emotion, and they know where they are, for lack of a better explanation. So you got to try and stay out of the way of getting hit in the face with the elbow. I know it's easier said than done, but that's the market we have, and these are the share size and being cautious in the first 30, 40 minutes on what decisions you make are really the only two things that we can control in that respect right now. Could you talk about share size and scalping? I saw a lot of times Andy take a big size until the stock breaks sideways, or is it better to take small size and then add after the breakout? That's a good question.
Okay, we're more on day trading now, basically.
Well, that particular question, I guess.
Yeah. Well, yeah, we'll hit on it. Yeah, a lot. It goes back to conviction. It really does. I can think of. Let's see, what was it? HGY is probably a good example since I day traded that and swung it there. But yeah, going back to this chart in HGY on this day right here, and it goes back to gut feeling. I think I bought a pretty good size right there. At the $4 range, and you know, I I don't like. I will add occasionally, but it's not on. A lot of times on these momentum trades, if I get a good feeling that the move's about to make, it goes back to gut feeling, and I'll grab size. I'll grab size anticipating, knowing that it's holding the moving average there. It's setting up really well down. If it pops up and then breaks down, I got a good entry, so I'm not going to lose a whole lot of money versus getting my pop and then adding another 1,000 here. I'm just killing my my average. And so then instead of a $4 average on this HDY, I may have a 405 now, and I could easily get wicked out and get turned into a flat. So, but in some cases, on a slower moving stock, Symantec was a good example on Friday. It was just nice trending stock in this one. It was nothing really explosive here yet, to go off of. And so I kind of just was just adding to that in my day trading, basically chunks at a time until, it finally just kept creeping higher. So it all depends on the trade there, honestly.
Mm-hmm. Let's see. Are there any stocks that HFTs don't trade? You know what, James? I don't think there are not. I think HFT is around in just about any stock. They're constantly watching the markets and coming and finding where the action is. So at any given time, HFT can come into any given stock. But there are certain stocks that have a reputation for being worse than others. Ford being one of them. A lot of the banks, Wells Fargo and BAC being another one. Some of the New York stocks, some of the big, thick New York stocks like Ford, Bank of America, Citigroup is probably one of the worst. These are just big, thick New York stocks that the HFT love to kick around. And matter of fact, Andy was trading Bank of America. Oh, no, it was Ford. I'm sorry, Ford. The other day. Market was going higher. Everything was going higher, Ford going lower, and it was just nothing more than the shakeout, because by the end of the day when the bell rang, it popped right back up to where it really should have been. So to answer your question, there are certain stocks to avoid, or to at least not to avoid, but just to at least recognize and understand what you're up against. Ford being one of them, BAC being one of them, Citigroup. The big thick ones is where they like. HFT needs volume. They need a lot of participants at each level to do their thing. That's not to say that some of the thinner stocks with wider spreads, there's still HFT in those things, but they're everywhere. They're everywhere.
They are.
Okay.
Now, getting back to that Ford, a good example, especially for you guys who day trade, I'm just, on Friday, this is just the other day, take a look at GM here, was just, moving higher, went to highs, you took out highs. Ford was actually looking good, strong. Kind of coming up here, looking like it wants to, possibly, break out and go to highs like GM did, and then you got that. Then you got a market move. The market moved higher out of its, range there, and look what Ford did, just continued to bleed lower. So, and just kind of like what that Bank of America we showed you earlier in the webinar is, it really is just anarchy in a lot of these stocks, and you don't know what they're going to do, and you don't trust your instincts anymore. So. The best thing to do is just try to avoid them. There's a time when they're, after maybe 2 or 3 days after earnings, where it seemed like they trade. Ford was a nice trading stock for about 2 or 3 days, and then just all hell broke loose, and it's back to the same old Ford.
And again, HFT is going to show up more in day trading than it will in swing trading. Having the wider stops and the smaller share size and the longer time horizon doesn't bother me as much when I see these stocks do what they do, because I'm not waiting tick by tick with bigger size to profit and play their game. So we're just pulling back, letting them do their thing, make their noise, but stocks are still moving to point A to point B as they're supposed to based on supply and demand. They're just doing it in much different routes, much different ways. Here's a common question, and it's a good question. Do you guys trade the higher dollar stocks like CMG, F5, and Apple? Occasionally, but quite honest, Jeff, they're not our bread and butter. They're not what we really like to trade. I had mentioned earlier, right now in some of these smaller cap stocks, it's so much easier to get a 10, 15% rip than it is to find that type of 10 or 15% move or setup in Apple or Google or CRM and some of these other high flyers. But that's not to say we won't trade it. We will, but it's just not my preference. There's a lot more noise inherent in those stocks anyway. With the higher price stocks, there's a lot more noise. It just hasn't been.
I got something to add to that. Yeah, especially when it comes to swing scalping. See, not only do you have to, fear in those stocks like F5 and CMG and things like that. Not only you have to keep an eye out for their earnings. You also have to keep an eye out for every stock that's in that sector's earnings, because you see what happens when to CMG and some of these other ones when F5's earnings the other day, Akamai. So you can wake up one morning and be looking at a beautiful chart that you just entered in a F5, and then all of a sudden you had one of its peers came out and they just barely missed, or they didn't blow out earnings, and they sell off 15%. You're going to take about an 9% probably haircut in the stock that you're in, and so you really got to be careful when you're swing trading those ones. Apple is, golden child there. Nothing, you can't do anything wrong. And I have swung Apple before. I was disappointed not too long ago. I kind of missed it when I was transferring my account over, and I was kind of pissed about that. But you really got to be careful when you're playing those, because you got to keep an eye out, especially in that cloud computing and sector and things like that. So
there's nothing wrong with those stocks. I just prefer things with not as much noise in them, not as much action. I shouldn't say action, but not as much back and forth action. It's a preference, and there's nothing wrong with trading those stocks, but it's just a preference. I've done better with the lower priced ones over the years. Mm-hmm. And I know a trader who does very well just trading Apple, pretty much. I don't know how he does it, but like I said earlier, trading is an art form. You play to your strengths and your weaknesses, and what works well for you and what doesn't. Another question here: frequently after the close. Just after the close, you will see very long wicks. Are these long wicks a tell of what's going to happen the next day? No, I think what you're seeing, Mark, is right at the close is very similar to what happens on the open, but it's more compressed in the close. We'll see these algos. Remember, they do not take positions home. They do not take risk home. Algos are designed to facilitate market transfer and be there for quote-unquote liquidity. So as you get close to the bell, there's like
he's talking about after. I think he said after the
after
close.
The bell. Yeah. Well, I just wanted to make a point. I just want to make a point. I just want to make a point that at the beginning of the day and at the end of the day, there's a rush in and a rush out. And I don't like getting caught up in the rush in, and I don't like getting caught up in the rush out. So I really avoid those two periods of the day. Try and play the middle of the day. I think what you could be seeing is just stocks close. Like I said, some of these algos wait till the very last minute before they close up. And you'll also notice at the end of each day, you'll see, like usually on the time and sales, the very last print going out is usually a bundled print. Even on the NASDAQ stocks, there usually seems like a big block print is the very last print of the day, as all the algos and all the positions get squared up and kind of matched in the last 5 minutes. I honestly think that's what you're pointing towards, is just the concept of HFTs being exiting the market every day, only to enter the next day, and that shows up at the close. Mm-hmm. As far as trying to see what happens.
I know what you're talking about.
Go ahead.
I was going to say I know what you're talking about, because a lot of times I'll follow little spiders and after hours, and I'm under the impression that there's still a high frequency trading squaring up. That's
in the spiders.
There's a lot of in the spiders.
Not in the stocks.
Yeah, you'll see some wild gyrations, right, in the spiders mostly, and I guess it could spill over into some of the stocks too, but I have noticed that on occasions in the spiders.
Yeah, where the spiders are like immediately trading 12, 15 cents higher right after the bell. It's like, well, why couldn't you do that during the market?
Exactly.
I think it's an HFT. It's a byproduct of HFT, unfortunately. Let's see. Sometimes I watch the bid and the ask to try and find direction. Friday the spread and SCCO was 1 or 2 cents all day long. Suddenly it moved to 6 or 8 cents and then moved higher. Do you watch this? We primarily play off of the charts. We pick our directions and our spots off of the chart, but we will look at the level 2 to time the entry, or rather time when to hit the button and take the trade. Like if a stock is very thick and it's 2 cents wide or 1 penny wide, and we're very close to making the trade, if you start to see time and sales move quickly and it's all trading on the offer and the sellers are disappearing, we might use as a trigger to enter the trade. But my point is, we don't study the level 2 and try and make sense of where the stock is going based on the level 2. We base that all off the charts, and we only use the level 2 and the time and sales action as a timing mechanism to either get in or get out.
Mm-hmm.
Next question. When you're allocating a percentage of your account for your positions, can you recommend a maximum percentage risk for overnight positions?
Good question, Sammy. And that all depends. A lot depends on the stock. The volatility of the stock. I wouldn't. We mentioned soda earlier. I wouldn't have a 20% allocation in soda. That's for sure. Something a new issue. But at the same time, if you have a lot of conviction, I've had as much as 20% on one stock. If I've had a lot of conviction in the setup, make sure, like Steve mentioned earlier, earnings are not coming up. You have to be really careful because that is a big allocation. I won't take more than 20%, that's for sure. But I think it's okay if you have a lot of conviction. But when I do get my move I'm looking for, I'm quickly offering out at least probably 10% of it.
I think that's a good number. 20%.
Yeah, 20% is probably the max.
The most we've ever really called out as an allocation is 10% on our swing trading service. Now, it brings up a good point because ditto trade, sometimes we're doing a bit more. There's been a couple occasions where we've done 15 or 20% in the ditto trade with good conviction. But the cool thing is they are now coming out with that ditto trade. They're coming out with a share per share allocation. So if somebody's following us on ditto, they can actually participate, which seems to be a common question here and of many people as well. How do I know how much to allocate? Well, the cool thing about this new ditto concept is if we take a trade and it goes out as a 10% allocation out of our account, anybody who is attaching themselves to that trade will also automatically, if they select it, take 10% of their account. So they can actually not only take the same trade, but they can match the same price that we get, and they can match the same allocation. I know that doesn't help people that are not in ditto trade, but I wanted to point that out there. But Andy brings up a good point. I probably would never go more than 20% of an allocation.
Mm-hmm.
That would be very, very aggressive.
Okay.
Let's see, VWAP, we don't use VWAP very much as a chart overlay. I'll glance sometimes at the level 2 just to see what the VWAP is. But a lot of times the VWAP kind of lines up to other areas of moving averages or support and resistance that we kind of see anyway. I'm not poo-pooing VWAP. I think it's a great tool for those that use it, but I don't use it every day as much as some people do. Brian Shannon's pretty good about that VWAP. I think he uses a 5-day VWAP to answer your question the best I can there. Another question, are take-home trades that closing at high, on high volume, are they still valid in your opinion? Yes. I'm glad you bring that up, Ellie. I like to trade, I think I've said it before, and you probably heard me say it as while you're asking that. When a stock closes at highs, I really like the prospects for a gap up the next day. Now, you also recall me talking a lot today about a stock that had a good 3 or 4% move, big green candle on the daily chart. Just be prepared that the next day could be a gap and go nowhere. It could be a gap in doji. I'm very adamant about the big moving day. If you have a good move, more often than not, that next day is going to be a pause or a day of reflection where the buyers and the sellers say, hey, wait a minute, what just happened here? But to answer your question, if a stock closes on highs, on good volume, I really fully anticipate overnight pressure to build and people to want to get in the stock the next day, and that's what creates a gap up the next day. Whether or not it follows through, you just have to wait for the stock to open and find out. Let's say a stock's up 5 or 6% and closes on highs, and the next day it gaps up 7%, I might be selling half right on the open and just take that as a gift, maybe even all of it, who knows, depending upon. But the point is, if you do get that gap up, don't get too greedy.
Okay. Here's one. It seems like you swing a lot of like this one, high beta stocks. Aren't they more risky? And that's a good question. And yes, they are. And there's a reason, why, I do that. And usually they're really good entries in cases like that. And that's where you're going to get, your 17%, your 20, 25% movers. And HCY is a good example. It's if you're stocking a stock, and you've been watching it, and you're really liking the level, and you have some nice conviction there at the $4 level. I know if I'm right on this thing, I'm going to get a good pop, and with 17% there. But as you can see now on the daily, it's even continued higher. The ideal situation would have been to sell half, and like I said, we're still working that out with Ditto. But to answer your question, yeah, when it comes to risk in a portfolio, I think a person is at more risk to be sitting in this market 100% long. Waking up to some Egypt prices on Monday morning, and seeing a 3% haircut in the market. We don't do that. Most of the time we're probably maybe about 40, 50, 60%, somewhere around there.
Right now it's about 60. Right now it's about 60
Yeah.
in the Ditto trade account.
Yeah. But we're realizing better gains in the S&P average because we're catching we catch these high beta stocks, as you refer to as and catching the good entries on there. The F-Tech, another good one. High momentum, high beta stock, but nice momentum, pulled back there. You catch your spot there. You're gonna get your nice moves, and that's why we don't stick around a long time in these things. We realize that. We realize they have the propensity to really wake up one morning and be have a big pullback. So we're looking for a quick move, sticking and moving.
Surfing the market.
Mm-hmm.
Yeah. Well, we said we'd go 2.5 hours. We're coming up on 3 hours, and that's pretty much all the good questions you guys have had. Anything else you want to hit on before we wrap it up?
Oh, let's see. I think there was probably a couple of them. Yeah, we wanted to talk about shorting. I wanted to throw out what I'm kind of looking at. Yeah, what I'm looking at right now a lot of times is in the market is it's overbought. It's getting a little overextended. You're seeing a lot of retail people join the party now, and it has the feel like at some point you could have a pretty big pullback. So what I'd like to do is stock sectors, and what I keep my eye on right now is relative weakness in the XHB. You can see here that looks nothing like the spiders. Here's a look at the spiders, the overall market there, trending higher above its moving averages, moving higher there. And here you have the home builders, and some other related stocks, Home Depot, Lowe's, definitely underperforming here in the XHB. So this is one I may be looking, and this can act as a hedge too. It's you're in some stocks that are working for you in the right sectors, and you're like, man, I don't know if I'm going to, am I going to be in trouble? If I wake up one morning, a big gap down or a big sell-off. Well, this is a way you can hedge. You can find a sector that is underperforming, and maybe look for a hedge by taking a short position in XHB. So that's an example I'll use for hedging. And there's always the SDSs. You can do that, but once again, they're gonna deteriorate over time. This is not something you want to stay in a very, very long, and it's going to be an inverse of the spiders. So if you got the spiders on 52-week highs, obviously you're going to be on 52-week lows. So that's a couple of ways you can look to short or to hedge your account.
Mm-hmm. Or just use the SDSs if you feel like you have too much allocated long, and you might want to hedge a little bit if the market's stalling or feeling uncertain. Are you still using trade ideas to locate stocks? That's a part of it, Mark. I would say intraday, as ideas are coming to us in real time, yeah, they're coming to us through trade ideas. But afternoon, we'll jot down stocks that we see throughout the day on a piece of paper. We'll run some scans and some other watch lists that we'll do some homework at night. So between homework setups that we have at night, setups that we find throughout the day and write down and stock, and then also alerts that come at us in real time. To answer your question, yeah, we're still using trade ideas to locate stocks. And we really do like using that alert software without a doubt. Another question here. Is there shorting in the Ditto program? Looks like you can use a cash account, so I'm guessing will not. Will you be trading inverse ETFs if and when the market turns? To answer your question, Will, yes, we can short in the Ditto account. We are not limited to just using inverse ETFs to establish short exposure. But there's really been no need in this market to be shorting. However, there will be a time and a place where we will start doing more individual short sells in Ditto. That account does allow us to do shorts, But for now, it just hasn't been in the game plan based on what the market's been telling us.
Okay.
Is there a scanner you know of or a way for filtering the momentum plays that's pulled back to the moving averages on low volume? I personally set manual alerts. You know, Ellie, there is. Trade Ideas does have, and you might want to investigate this, the Trade Ideas guys have built numerous alerts to do almost anything, and they have parameters to alert you when a stock is maybe in an uptrend and it pulls back and touches its 20, or it pulls back and touches its 50, or pulls back and touches its 200, whatever you want. So I believe there are some ways in Trade Ideas. And you know what, if you haven't used it yet, why don't you email me and I can set you up with the CEO Dan at Trade Ideas, and he's been giving some of our customers a free week trial just to play with it and see if it works for you. In a week you can get a good idea of whether or not it works for you. Mm-hmm. Somebody's asking how will they be able to watch this recording. They missed some of it. It's pretty simple. And I'm going to compress the video today, and it'll be available more than likely today or tomorrow on our website. You're all entitled to certainly a recording. Just email me, and what I'll do is I'll get back to you. I'll give you a username and a password. If you don't already have one with Today Trader, I'll create one for you, and that will enable you to go into that page and download this media from today so you can keep it on your hard drive forever.
Okay, I'm gonna finish up here, guys, on a kind of a story that everybody kind of likes. I want to get back to the psychology of trading and fear and hope, and because this played a big part in me being able to turn it around. You know, after my first year of trading, this is going to day trading, but it also helped in my swing trading and everything. And it's basically getting back to fear. You know, like a lot of traders, of course, I didn't have anybody to help me. Me and Steve both learned on our own, and it was painful and it was expensive. And I started out with about 50,000, and the first year was really tough, tough learning experience, and I got down actually after about 1 year to about 8,000 in my account, and I accepted the fact that, hey, you know what, maybe I'm not cut out for this. You know, I was pressing, I was a lot of fear. Yeah, you drained a lot of money, and I'd about just thrown in the towel. As a matter of fact, I got to the point where I went home one night, updated my resume. I said, oh, well, I guess I'm, going back into the marketplace and putting the monkey suit back on, and going back to work. But, and like I said, the count was down to minimums, and I went home that night and did the resume, got it all ready to go. Accepted the fact that, okay, well, got 8,000 left. Let me go back to work here and see what I can do with this, So, and when I did that, I kind of lost that fear. I kind of accepted, it turned more into a game to me. I was no longer afraid. It's like I accepted the fact that, hey, if it doesn't work, the worst thing can happen is, I gave it a shot, lost some money, go back to work. And when that happened, I can't express. The market was kind of good that time. That helped, but that wasn't the main part. It was losing that fear element. And like I said, you have to treat it as a business, but there's a very fine line here, and I've realized over the years it's business, but it's also a game, and you got to lose that fear of trading. And once you can get behind the monetary aspect of it, and that's hard to do. And treat it, more like a game. That's why paper trading is so easy, guys. There's no, emotions attached to the monetary aspect of it, and that's why people do so good when they paper trade. So because it's a game at that point. It's not a business. It's not, you're not stressing out over the money. So. So anyway, I just want to throw that out, man. If there's any way you can make yourself realize, hey, it's only money, what's the worst thing can happen is I'm out, and life will go on, and I'll find something else. But once I did that and put it behind me, it's amazing. I had just I turned around within 3 months. I think I made all that money back plus 30,000. So. It was a drastic turnaround, and the market did help it, but it was an amazing turnaround. So I just wanted, because a lot of people found that story very interesting. I mean, because I was about to throw in the towel, give it up, And when I did that, I kind of just lost
Almost
that
like
element of fear.
almost like a mental capitulation. You come to grips with
Mm-hmm.
what the real downside is and put the real downside in perspective, and it kind of takes a little bit of the pressure off. I know it's very
Yes.
abstract and more easier said than done, but yeah, I can relate.
Mm-hmm. Absolutely.
All right, guys. Well, thanks for attending the live webinar. Like I said, email me half a day or a day so to get access to the recording, and you can own the recording, download it, keep it for yourself. I guess that's it.
Okay.
Enjoy your weekend,
Yeah, I hope you
everybody.
guys enjoyed it. Thank you for your kind words out there I'm seeing in the
Yep,
question
thank you.
box.
Thank
And
you.
yeah, have a great weekend, guys, and hopefully we'll see some of you guys down there. I know a few of I noticed, recognize some names in here. I know see a lot of you guys on Monday morning.
We'll
So,
be seeing you guys again, I'm sure. If not Tuesday
all
night
right.
for an update. Go Vonage, go Walmart, go Symantec, go Gold, G-O-D.
There you go.
All right, guys. Thanks a
All
lot.
right, guys.
Have a nice weekend.
Have a good one. Bye-bye.